trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
The Fed has been trying to talk this market down, and in the end, the equity market has simply ignored it.
Different sectors of the economy are performing in different ways.
The market's gotten more and more selective.
I think we can all agree that the economy is a lot less interest rate sensitive than we thought.
Every single leading indicator of a recession is flashing red, deeply red.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An historic moment on the independence and the certainty of the Bank of England. They go against consensus and raise rates 50 basis points. The vote was 7-2, and Lisa, you see it immediately in sterling on 127 out to 128.26.
Some of the commentary saying the full impact of rate rises will not be felt for some time. Seeing the UK economy stagnating in the second quarter, but growing in the third quarter. How does this cohere with this idea of more aggressive rate hikes? The 7-2 split, very interesting at a time when the vast majority of commentators thought that this would just be a 25 basis point hike. They went against it, took a page from the Norwegian Central Bank, and went 50.
And I think that's very important. The combination here today of the action of the Swiss, what we saw in Oslo, and now what we see in the United Kingdom is, with respect to the Bank of England, Lisa, the lesser banks saying enough, we're going to act.
They say that inflation is expected to fall significantly this year. They do say, though, that further tightening will be needed if signs of more persistent inflation persist. Ongoing feeling that there was some sort of unanimity with respect to the importance of hiking rates. Nobody on the committee thought that it was important to keep rates where they were, not raise at all. All of this coming together to give you a sense of higher yields for longer, and that is what we're seeing certainly in the UK bond market.
We're going to go to Lizzie Burden here in a moment, but Lisa, right now I want to look at the single phrase, and each bank has their own set of headlines that roll out in the Bloomberg 2030, 40 headlines. Euro's very much time, 2025 and all that. Here on the emotion, and perhaps in the letter to the Chancellor from Governor Bailey, the bottom line is a tight labor market. I would suggest, Lisa, over the last 18 months, that's collectively what the central banks have gotten wrong.
What you've seen over in the UK is wage increases far above what we're seeing in the US. I believe it's around 7.5% year over year. I was reading about this. Lizzie, I'm sure, can correct me, but that is far above what we're seeing in the US of about a 6% rate. And it starts to raise this question of a wage price spiral when there is more labor pushback, when there are strikes, when you're seeing that in a visceral sense, pretty much across the nation. I don't know what they can do. Is this structural, and how much are they going to comment on this in this meeting?
To give us perspective from Queen Victoria Street, Lizzie Burden. Lizzie, were you shocked by this 50 basis point move?
I was, markets will be, and economists too. I was speaking to economists just before this decision. One of them said that if they went for 50, it would reek of panic, but they've done it nonetheless. You've got two dissenters in Swati Dhingra and Silvana Tenreiro, and it's a shock even that they're not holding, that they are hiking anyway, when they have been repeatedly emphasising the lag in monetary transmission. As you say, it follows the other central bank this morning. They're really trying to get a grip of inflation after that fourth inflation surprise yesterday, and the tight labour market too. The risk becomes about recession. Now, Bloomberg Economics research showed that if rates get to 6%, you could see a recession here in the UK. It's difficult for the Prime Minister Rishi Sunak when his number one priority is fighting inflation. But if it takes a recession to do that, one of his other priorities is growing the economy. Can he hit both of them? Looks more doubtful. But of course, this is more pressure for mortgage borrowers, so it ramps up the pressure on the Chancellor, Jeremy Hunt, to do more to help people who are going to face even higher risk of repossessions now, but he doesn't want to go against the Bank of England.
Well, Lizzie, there's a confusion here in the forecast that we saw from the Bank of England today. They see stagnation with respect to the UK economy in the second quarter, but a bit of a rebound in the third quarter. Is that coherent with 5% rates in the region and potentially 6% rates as soon as December?
Well, if you look at the SHOK shock function on the terminal, as I say, 6% rates is where Bloomberg Economics sees a recession being triggered. And now that we've already got this half-point hike today, I expect that markets are going to be pricing an even higher peak rate. They were seeing 6% before, some traders seeing 6.25%, so you can expect those bets to go up.
Lizzie, I met at the IMF meetings. I had a wonderful panel, including Tenreiro of Argentina, who's visiting at the Bank of England and exits soon. From where you sit and studying this each and every day, is this a hawkish or a dovish Bank of England?
As I say, when there isn't a press conference, the bank can communicate its messaging and its future path through the vote split. So clearly, it seems to me, the bank is trying to communicate that this is a hawkish, they're being hawkish through the vote split. The fact that none of them have gone for a hold is that message all over. But remember, this is Silvana Tenreiro's last meeting. She's going to be replaced by Megan Green from your side of the pond, Tom. And she too has been making hawkish noises, unlike Tenreiro. So perhaps it could be even more, we could see more hawkishness in August.
I will suggest that Megan Green has not been making hawkish noises on Bloomberg surveillance. We've been scrupulous not to jeopardize her path to the Bank of England. Elizabeth Burden joining us this morning from Queen Victoria Street here in truly an historic moment. There's no other way to put it. As a sideshow, moments ago, the Turkish Central Bank says tightening will be timely and gradual. Lira pops out to a new weakness over the last number of days. A sideshow, but nevertheless idiosyncratic and important, as Lisa would mention. Right now on this story, and for those of you in America, we do have a deterioration in futures off of the Bank of England announcement, maybe fractionally looking towards a more hawkish tone from the American Central Bank. We have Jay Powell again today, right, Lisa?
10 a.m., yep.
10 a.m. We've got Jay Powell. Maybe we'll get some color there on what we see from Switzerland. I'll get it. It's an S country. Switzerland, Norway. I'm doing well this morning. Thank you. Switzerland, Norway, and now the United Kingdom. With perspective, Sri Kochagavaden, senior research economist at Aberdeen. Sri, I'm absolutely fascinated by how you link together the actions of Switzerland, Norway, and now the United Kingdom. Suddenly, is it a hawkish tone in Europe?
I think this is clearly a hawkish tone from the UK and from Norway as well. Clearly, this they've surprised the markets. Norway this morning surprised with the 50. There was running into this. There had been quite an intense debate. There were question marks about whether there would be a 25 or 50 basis points from the Bank of England, also for the Norway as well. But clearly, this is a surprise. And just running through the statement quickly, the reasons are very clear. This is something that has been signaled actually within the speeches for some time. it is the core services inflation, which has been incredibly strong. Yesterday's data really did help trigger that debate about whether 25 or 50 would be necessary. This is really a very, very strong picture for the UK. If you compare the UK with other developed markets and look at that wage number, it is really standing out with an increased wage pressures there, while other countries are starting to see a bit of a stabilization or a rollover. If you look at other European countries, if you look at the Fed or the US, the UK really stands out from that core services and wage pressures angle.
We're watching the pound strengthen in response to this surprise 50 basis point rate hike from the United Kingdom, which is a departure from what we saw for the Liz Truss era. Sri, how much is this a positive sign that shows people believe that economies can withstand higher rates to a much greater degree than they thought just even 6 months ago? And then it really gives confidence that you can fight inflation with higher rates without creating some sort of deep recession?
I think that's going to be very challenging, to be perfectly honest. I think that, the fact that we've moved to 5%, markets are pricing in 6% the last time I looked earlier this morning. This is really triggering a recession. Now, monetary policy works with long and variable lags. That's something we often hear. And what we're seeing here is that we are, monetary, financial conditions have tightened significantly. There is some question mark whether the Bank of England will raise as high as 6%. There's definitely further to go, potentially, but 6% would be triggering not just a recession, but a much more severe recession than economists are currently forecasting. Now, we do feel that the monetary tightening will trigger recessions in a number of different countries. I think a soft landing is very difficult, and unemployment rates are starting to nudge higher, but the tightness in the labor market is very worrying in that the longer the recession is delayed, the more severe we could see in terms of rate hikes and recession later on next year.
Sri, inform our American audience, which we understand the dynamics of a fully employed Ohio or Kansas versus challenging city unemployment rates, perhaps in America. The perception we have is London booming, the South blooming. I'm thunderstruck at double-digit unemployment in Aberdeen, way up in the northeast of Scotland. How uneven is this debate on monetary policy across the United Kingdom? How much of the United Kingdom is truly in recession right now?
I think there is a regional issue, and that's something that really needs fiscal measures to really address. Now, from a monetary policy perspective, the Bank of England are limited to what's happening to the aggregate inflation rate, what is their target, and how do we get back to the target? So the regional divergences is very difficult to tackle without fiscal measures and structural policies to target those issues. Now, if we think about what's happening in terms of a recession, we're not quite in a recession yet. We've seen some weakness in data. For Q2, we have a number of different drivers. We have strike action, particularly in the healthcare services. We had an extra bank holiday for the King's coronation. All of these issues will lead to some weakness in activity, but that's not necessarily a recession just yet. What the Bank of England need is for the economy to cool so that some of the imbalances that are driving inflation start to ease, and you start to see more sustainable deceleration in that core services area, and we're not seeing that yet.
Okay, Sri, thank you so much. Just really outstanding. Sri Culture-Government with us with Aberdeen. This truly historic moment and gyrating moment for the United Kingdom. Sterling 128 to 127.55. The Standard & Poor's 500 down 0.3%.
If you're just joining the program right now, we've been talking about how the hawkish tilt of central banks around the world has gained steam and will continue to do so. This one, though, you mentioned this in brief, Tom. Turkey raising rates, doubling interest rates, goes against all of the ethos of Erdogan over the past couple of years. This is the first rate hike going back to 2021. And this, to me, really highlights perhaps this is a recognition of a policy that failed, that they thought cutting rates would actually curtail inflation that has absolutely spiraled out of control. And now perhaps they're about facing and saying, okay, central banks, the rates are going to rise from 15% to 15% from 8.5%.
This is the changing of the guard for Erdogan. And, you know, I've read a fair amount about this. When I was in Turkey, a fair amount for Bloomberg, at least it's what I would call early Erdogan. And then there was middle Erdogan. And recent Erdogan has been very geopolitical, obviously with a huge distraction and import of where they are to the Black Sea and the war in Ukraine. But you wonder if this is a new Erdogan, as personified by Simsek, Mehmet Simsek, the new finance minister, hugely esteemed by the Western financial community, and also a new head of the central bank, again making a huge splash here. So I think, first of all, I think that we need a road trip. Surveillance in Istanbul, I think, would work.
Yes, I would. A food road
trip. But, well, it can be a food road trip as well. But I think this is important, and you see it in Lira, 23.60.
I think you're spot on about the new leadership. Formerly of Goldman Sachs, of First Republic, of Princeton, heading over there.
Yeah.
Maybe this is a real sea change, at least for the moment, in terms of monetary policy.
A sea change at the Bank of England, too. They surprised and increased rates sharply, 50 basis points. The press conference of the governor of the Bank of England later. Stay with us. This is Bloomberg Surveillance.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Exclusive today, Ukrainian Prime Minister Denis Shmyhal sits down with Bloomberg's Maria Tadeo, live from the Ukraine Recovery Conference in London, only on Bloomberg, your global business authority.
We never used the word pause, and I wouldn't use it here today. What we did was we agreed to maintain the rate at that meeting. Almost every single of the 16 of the 18 participants on the FOMC wrote down that they do believe it'll be appropriate to raise rates, and a big majority believes raise rates twice this year. And I think that's a pretty good guess of what will happen if the economy performs about as expected.
The chairman of the Federal Reserve speaking within the last 24 hours, and this before action by Switzerland, action by Norway, and now abrupt action by the United Kingdom to get their hands upon inflation. We're ripping up the script this morning for Bloomberg Surveillance. because there's a lot going on here, to say the least. We need an update on the break. Bramo looking at cable. Cable stronger, as you'd expect. Higher interest rates, more attraction. Money comes in to buy merchandise for the Abramowitz family on their next trip to London.
Stop projecting.
And then it gave it back. 127.61 is not a small matter.
It's sobering, because what it means is that people are looking at an outsized rate hike and possibly more as hurting the economy, as not necessarily being supportive for the longer-term prospects for the United Kingdom. This is not what the central bank wants to see. There were no good options, and what this highlights is this isn't the necessary, obvious solution.
Way out front on this morning was Kit Jukes of SocGen. In his morning note, taking the Clint Eastwood path, he talked about the good, the bad, and the sterling, and that it is, if you raise rates, it's good for your currency until it's not. And you wonder if that's where we are.
Right, and how much do we see this in other economies as well, at a time when you have these two tensions? Rate hikes good for the currency typically if it kills inflation, but slower growth bad for our currency. And when that starts to take over for the hawkishness, then central banks are between a rock and a hard place, hiking into weakness, and that's where we are in a number of places.
Oil, $70.90, gives way by $1.63. Maybe that's some of the recession slowdown. Angst out there. Dollar weaker again. We're monitoring sterling closely before Governor Bailey's comments. 127.64. It is a political discussion always with Daniel Clifton. He's head of policy research at Strategas. It is a Baird company. But with Dan Clifton, just because of all that's going on in the international space and from Chairman Powell, Lisa wants to go issues. Dan, I'm going to go just simple. Inflation. In your world, is inflation just simply what's the price of a gallon of gas?
Absolutely. In politics, that's exactly what it is. If you look at the University of Michigan consumer expectations, inflation expectations are coming down, largely tracking with the price of gasoline. And Tom, I think just generally, though, you've seen a pretty dramatic decline in inflation in the United States. We were at 5% a month ago. We're likely going to end June at 3%. To move from 5 to 3% is an enormous move down. And it shows that there is progress being made on the inflation front, and it's happening faster in the United States than maybe in some of these other areas. And that's why these central banks around the world have to continue to tighten. But we have a money supply contracting here for the first time since the 1940s. It is having the effect of getting inflation down, but it's raising economic risks, and that's what we're starting to see.
Are the politicians aware of those economic risks? When I look at a given unemployment rate in Kansas or Ohio, I'm looking at 2.x% unemployment. That doesn't sound like a recession.
So I think there's some hope here and hope is not a strategy, but there's some hope here that you can actually get inflation down and employment is remaining strong. The problem with that is that you're now in the middle of a pretty big liquidity drain. We drained about $80 billion of liquidity in the last 3 days. That's why you're starting to see a rotation in the equity market, and you're starting to see some volatility build in there. And so you have slower growth, you have less liquidity, and you have tighter credit. That's what's coming out of these Powell hearings, is that banks are tightening credit because of all the banking issues, and that starts to affect jobs. So I tend to think that we're going to have weaker growth in the second half of the year. Politicians think we may be able to do that without avoiding a recession because they're still focused on inflation. I think the recession risks here are growing.
One of the key and perhaps underappreciated risks of the past 12 months has been the fiscal impulse, the fact that you have gotten some increasing funding from the federal government at the same time that the other hand is trying to fight inflation. That's going to change in October. A lot of people are focused on the fact that people are going to have to start paying their student loans once again for the first time in 3 years, and this is going to hit disposable spending and disposable income pretty significantly. How significant is that, or is this basically just window dressing, a normalcy after so many years of fiscal stimulus?
Yeah, so first, I think that it started this week where the TGA is no longer offsetting QT. And so this was the first week we've had QT post-debt ceiling. And so the liquidity drain has started. The next step is exactly what you're referencing, Lisa, and that is the student loan payments coming back in. It's very likely in the next couple of days, the Supreme Court is going to rule down President Biden's student loan forgiveness plan, which would have forgiven balances as much as $20,000. And then you're going to have these student loan payments come in. That's about a 0.2% of GDP drag when that consumer hits. It's meaningful. It's not something that should be viewed as insignificant. And we anticipate that the president will put forward a plan to do what's called income-driven repayments almost immediately after the Supreme Court ruling to try and at least offset some of that drag from student loans being deferred. But students with loans have not had to make payments for almost 3 years now. They've allocated that to other spending. And once those student loan payments begin to come in, it will begin to divert funds back into student loans. And you see it with stocks like Sophie, which are up dramatically since the debt ceiling deal, which forced these payments to come in, and some of the weakness in the consumer stocks.
I was reading a Morgan Stanley report about this last night, and they were talking about how this is about $200, $300 per borrower. There are about 40. There are 27 million borrowers still with these loans in forbearance. About $41,000 of debt per borrower. How much is this going to accelerate the decline in inflation, or is this something that's really peripheral that people are just sort of clinging to with the hope that it will disinflate things faster?
Yeah, I think it's going to have more of an impact on growth than it will on inflation, because the money supply contraction is really taking care of inflation. There's about a 16-month lead between money supply and CPI. We've been negative for a while, so inflation is going to come down even with these payments kicking in. What it does is it begins to slow the consumer down, which has been the engine of growth. And the key issue will now be whether jobs continue to hold up, because if jobs hold up, this is somewhat manageable. But if you have this drag on the consumer hitting while jobs are slowing, then it will matter. And the key metric here is to watch the household survey and the payroll reports, because if credit is tightening at the banks, that will show up in the small business sector, and that's what's reflected in that household survey. And that's what we're concerned about as we go into the second half of this year.
What we're concerned about, Dan Clifton, is we need to know the zeitgeist of Washington here as we roll into a heated and hot summer. Dan Clifton, stay with us. Wiley Nickel, Congressman, 13th District of North Carolina. Of course, an outlandish question to the chairman. And of course, he's an Obama guy and all that. So you just know that he's got Jerry Garcia nailed down. Wiley Nickel to Jerome Powell.
I was excited to see that from public reporting that you were at the most recent Dead & Company show. I've been to this version with John Mayer and enjoyed it, but we weren't here. How was the show? Did you like it?
Oh, it was terrific. What can I say? So it was great. I've been a Grateful Dead fan for 50 years. So.
Oh, I could see him as a young lad buying those white cassette tapes we used to buy. Alabama Getaway. Dan Clifton, this is the talk of the financial community here. Are you a dead end? Can you drive forward the effect of Dead & Company on the nation's monetary policy?
Absolutely. We think that the Fed delayed rate increases partially to help Janet Yellen be able to raise $1 trillion of T-bills that has now taken place since the debt ceiling has been raised. It's a very clumsy discussion, as you saw yesterday and you saw at the press conference last week. If you think you're going to raise 2 times, why are you doing it now? The answers somewhat are getting better from the Fed, but it's clear that if the Fed rate goes up, the reverse repo rate goes up, and if the reverse repo rate gets up, less money will come out of reverse repos to suck up that treasury issuance. If it's not coming out of reverse repos, that means it's coming out of bank reserves. And that starts to put pressure on the banking sector. That, to me, is the key issue. And the read in these articles in the financial press over the last couple of days that liquidity is not being sucked up is just not correct.
Dan, we got to leave it there. Dan Clifton, thank you as Strategas, and we thank Wiley Nickel for driving forward the conversation in Washington. This is Bloomberg. Stay with us.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Surveillance correction. Sometimes I can be wrong. I thought there was a Bailey press conference. I'm told I'm wrong. I just assume they're over communicating like everybody else.
Under communication.
How quaint.
We need to go to communication therapy. The Fed needs to give some lessons to the bank.
They need to find their inner self.
Exactly.
Maybe he needs to listen to the Grateful Dead. We'll have to see there. Good. Thank you, Wiley Nickel, for enlightening us with Chairman Powell's view on Dead & Company. Today, the pound is dead. There's a lot of huge research output right now. Jordan Rochester, I thought, Lisa, was really quite something here on sterling, up to 128 on the shock of a 0.5 percentage point lift. He says, yeah, and then they worry about slowing down, so it comes down. And what's important here is insight that Jordan Rochester from Nomura's insight that now the Bank of England is becoming like the Fed, where they're going to react tick by tick to what the inflation story is.
And the inflation story is sticky, and the wage pressure is significant, and this is going to be very concerning at a time when they are fighting off some sort of downturn. So here is the tension. Have we shifted into the point where the potential for slower growth offsets the rate hikes in the currency space and starts to detract potential investors, Tom?
Also, another story we're watching in Turkey, it's not working. That's all there is to it. There's an underwhelming feeling to what Simsek and the head of the central bank have done here. They have acted off of the huge difficulties in Turkey, and we have a much weaker Turkish lira now, getting out threatening 24 lira per dollar. We'll do much more on that, because in a moment we've got the right guest for that moment. Futures at negative 15, Dow futures negative 116, the VIX still under 14, 13.92, the 2-year yield 4.74%. I guess it's a recession, but you don't know it in the home space, do you?
That's what I'm shocked by. So KB Homes came out yesterday, and they reported earnings that beat all expectations. They came out, had a very strong quarter. This coheres with what we're seeing across the board. Their shares are lower today. I really can't explain it. 2.5% lower, except that perhaps people are looking out. If they view stocks as a discounting mechanism, perhaps this brief respite is going to move into something of a higher rate and weaker housing market. I'm going to keep my eye on this. Boeing shares also lower by 3.4%. And this is the other story, the labor story that we keep talking about. There is a potential strike at its biggest supplier. Union workers voted to have a strike. To me, again, this is something we keep seeing around the world, the labor pushback that's going to keep raising prices. And I'm watching NVIDIA and Tesla. NVIDIA shares up 194% this year. Right now, taking a bit of a breather, down 1.2%, continuing that slow grind lower that we've seen over 3 straight sessions. And Tesla shares up 110% so far this year, lower by 3% as people also reassess whether it's gone too far, too fast.
Moments ago, so the guest is so timely here on Turkey, Lisa, we just got to stay with that. Moments ago, the Turkish lira, in failure of their policy, breaches through 24. That's just a shocking number to see this explosion of Turkish lira up. They raised rates, but not enough. market speaks.
It's not making sense. And right now, you can get the move right, but you won't necessarily get the market reaction right. To understand the confusion of the market response, Terry Wiseman, global interest rates and currency strategist at Macquarie, joining us here. Terry, what do you make of that? The fact that you can find out what they're going to do, but you're not going to figure out what the market response is going to be.
Look, I think it takes a long time to rebuild central bank credibility once it's been destroyed. It's not an overnight thing. Even with the replacement of the staff and the decision makers there, it's going to take a while for a central bank that has avoided raising interest rates to gain the credibility of the market. The market's going to have, they're going to be doubters. And I think when you have a situation like this, it's important for the central bank to start to reassert its credibility by doing more than the market expects, not less than the market expects. I want to make a case that in those emerging markets that have tried to tackle the inflation story head on and early, you have seen a lot of success. Obviously, Turkey's not one of them. But look at Brazil. They're on the verge of starting to cut interest rates, perhaps as early as August or September. Same with the Chileans. These countries were aggressive in hiking rates during the inflation up move, and they're going to be early in cutting rates with the inflation down move that they're seeing in these countries. Turkey's an exception here.
Okay, it's an exception. However, it's piling on the hawkish tilt that we've heard from central banks around the world today. The Bank of England, we've seen the fluctuation of the pound. Has the Bank of England lost credibility as well?
I think it did, but I think that's exactly the reason why it had to raise by 50 basis points instead of 25. Now, granted, we did not expect that they were going to raise by 50. The tone coming out of the MPC members in their parliamentary testimony a few days ago did not signal a hike of 50 basis points, but at the same time, you had an inflation print since then, whereby implicitly you can make a case that the Bank of England had made a mistake. They thought that inflation was going to come in at about 8.3, 8.2%. In fact, it came in closer to 9. I think it's because implicitly this 50 basis points is an admission of the mistake and a way to correct it. And I think that's why it happened.
Alan Schwartz put this team together at Bear Stearns with your leadership, Emmy Shayo and David Malpass driving the U.S. and Global Dialogue, John Writing as well. Terry, you've seen this so many times before. How do you link, we rationalize idiosyncratic stories like Turkey or Argentina back to the central banker of the world, Jerome Powell? How do you link Powell's actions to what we're seeing unraveling here, there, and everywhere?
I think we have to be very cautious if we're going to assume that what Jay Powell is going to do is going to be overly dependent on what other central banks do. And I think even the vice versa case is pertinent as well. The situation in the U.S. is not the situation in the U.K., or for that matter, the situation in the euro area. There is not as much labor activism and labor strikes in the U.S. I know that the headlines might be prominent, but we can measure this. And the peak of labor activism in the U.S. took place last summer. It has since died down. It makes plenty of sense. We've seen more layoff announcements in the U.S. The UK and Europe are very different. We're seeing a lot of labor activism now. We're seeing a lot of concessions by the private sector, even governments, to these higher wage demands coming out of the workers. And as a result, the UK and Europe are delayed with regard to their ability to fight inflation and bring it down. If you look at some leading indicators of inflation in the U.S., they are clearly coming down, and much faster than they are in Europe. The PPIs, for example, the survey-based indexes that we're getting from the ISM Services survey, the Atlanta Fed's flexible price index, they're all pointing downward for inflation in the U.S. I have a feeling, and by the way, Powell even hinted at this in his testimony yesterday, I have a feeling that in the back half of the year, you're going to finally see that so-called stickiness that we're seeing in the PCE inflation index and the CPI inflation index start to recede and come down. And by the way, I think the market understands that. And that's why the dollar has resumed being weak again, because it sees the Fed coming to an end with its rate hikes. It doesn't see that yet in Europe or the UK.
When we go into the mid-year reviews, JP Morgan publishing theirs this morning, and they call our disinflation path incomplete. But at Macquarie, one of your great studies has to be the greater number of lesser countries really struggling, as you just mentioned. Is the IMF going to come to the rescue here, or is the IMF lost credibility as we talk about the Bank of England challenged by credibility?
Well, if you mean the IMF coming to the rescue with regard to the debt load in the emerging markets.
To Argentina, peso 251, black market 507.
I don't think that you're going to see that happen unless these countries adopt a much more market-friendly and much more Washington consensus-based approach to the policy agenda. The IMF is not going to bail out countries that have made a succession of mistakes in their political economy and their policy agenda over the last few years. It will bail out those countries that it can impose on an agreeable basis a new plan of action with regard to fiscal responsibility and monetary policy responsibility.
I want to go back to something you were talking about, that there does seem to be a real difference between the inflation dynamic in the U.S. and the inflation dynamic in Europe. And you were talking about the labor dynamic in particular. Right now, what we're seeing are a number of central banks that paused or tried to, and now are going back and hiking rates again. This is exactly what people do not want to see. What gives you confidence that the U.S. is not going to be in the exact same position with a stickier kind of inflation, especially driven by areas like the housing market that have shown incredible resilience to higher rates?
Yeah, these are all great questions. Let me start by saying that the way that the PEC price index is computed or calculated, and the way that the CPI inflation index is computed, has inherent stickiness in it. About 40 to 50% of all the prices in that basket are imputed. So to get a really good sense of what flexible prices are doing, what prices are doing that you can actually observe in the marketplace, you have to look at narrower indexes. You have to look at only the basket of things for which we can observe prices. And when we do that, we see a lot more disinflation already. Just compare, for example, that Atlanta Fed index, the flexible basket versus the sticky basket, has seen a huge divergence in the last few months.
What is the potential shock to longer-term rates if this is somehow reversed, if somehow people are getting it wrong and inflation does remain stickier in the U.S. and follows the European story?
Yeah, so if that's going to be the case, you're going to see the back end of the yield curve go up a little bit in the U.S. At the same time, it doesn't mean that the curve will get less inverted, because we could see short-term rates go up as well. I should say, however, but to the extent that we're going to see longer-term rates go up, it's going to be because inflation break-evens go up. It's going to be because that inflation expectation goes up, not because real rates go up. But yeah, that would be effectively the result. Long-term inflation expectations goes up, inflation break-evens go up, and that drags higher the 10-year yield in the U.S.
We're linking monetary policy in here into the interests of Chairman Powell. And you mentioned as we were going on air here that you had the immense privilege of seeing Jerry Garcia. I can't believe it's been 27 years since he died. That's the first shock. But you saw the dead when the dead was the dead, and not the dead and company now. And to parlay off this, I'm going to go to what a long, strange inflation this has been. What does a pandemic disinflation look like? This is an original inflation, isn't it?
It's original only insofar as the Federal Reserve and a lot of central banks made the mistake of printing too much money at a time when they thought that the pandemic would not end, or at least they took the risk management view that there's a possibility that the pandemic doesn't end, and therefore they erred on the side of inflation, of liquidity balances in the economy. The important thing to keep in mind is that those impulses that created the inflation in 2021 and early 2022 are more or less over and done with the possible exception of wage pressures in Europe. If you look at real monetary balances in the U.S., because of inflation and because of QT, they are back to trend level. They went up about 15 or 20% above the trend, and they've come down 15 or 20% back to the trend. That's a very strong indication, a very strong suggestion that the inflationary impulse that the central banks had created is no longer in play. It's no longer manifest.
The longest dead concert, Terry was at the concert. He stood for 6 hours. The longest dead concert ever.
Stood.
6 hours.
Okay.
It's on the edge of Springsteen.
Yeah, they have epic concerts, and evidently they used to have even more epic concerts as
Get a little older.
Was.
Terry Weissman, thank you so much.
My pleasure,
perfect
guys.
day, just perfect time to have you in here with the challenges that we see in Turkey today. They are attempting to move beyond Erdogan's monetary policy. Standard & Poor's right now down 0.3%.
When you mentioned Turkey, the lira is now the weakest on record, dropping 2.5%. So failure is correct. And I keep wanting to go back to what Terry was talking about. It is a credibility gap. And once you lose credibility for a central bank, it takes quite a bit to get it back. And an about face doesn't necessarily take do the job, just simply because it raises more questions than it does gives answers.
Let us summarize right now. We're going to do that as we move through the morning here. Again, an important conversation. Maria Tadeo with the Prime Minister of Ukraine coming up in the 8 o'clock hour. But Lisa, let's just summarize up here. We started with Switzerland and Norway, with what I'm going to say are fairly shock increases in interest rates. And then, and as Lizzie said, no one really was calling for this 50 basis points from the Bank of England.
It was a surprise. It was not the consensus, which called for 25 basis points. They also talked about potentially raising rates even further in subsequent meetings. Then you had the Bank of Turkey, central bank there, raising rates too, which is completely a separate story, and yet still jumping on this train. Do we see a different story in Europe? And if so, will these be enough? Will this be enough to curtail some of the inflation and the wage dynamics while not torpedoing growth to such a degree that you scare away a bunch of investors?
I was weaned on this off of United Kingdom economics, and this is Beveridge and the rest of them a century ago. Clement Attlee as well, and Terry Wiseman, Dr. Wiseman nailed this, where it's about the labor differentials, the labor union structures and negotiations, almost the guilds of another time in Europe versus a much more free market wage discussion in America.
And we've seen it much more in the United Kingdom, akin to what we see in France, in Spain over the past couple of years. And that's one reason why people see inflation surprising to the upside in that nation.
Sterling 127.82 there, up to 128 and comes back here in the last hour. 10-year yield 3.74% in the United States. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
We see the momentum. We see a Q2, to be honest, Q2 2023 from a revenue point of view, which is higher than Q2 2022. So overall, I would say this bank is faring well. In Q3 and Q4, there is momentum in the business on the fixed side, but for us as a strategy of Deutsche Bank, it is important that we further balance out the investment bank overall.
Christian Saving, the Chief Executive Officer of his Deutsche Bank, overlooking the Deutsche Bank area from our Queen Victoria Street. They own the wall at Broadway and Winchester House, a really important discussion with a bank of Germany and a bank definitely of Guy Johnson's London. Guy Johnson joins Lisa Abramowitz and myself now to talk about Deutsche Bank and the path forward. The immovable force here, Guy Johnson, is the bank has underperformed since time began. He's righted the ship. There's no question about that. When does the street begin to give Deutsche Bank a valuation of a higher book value?
Look, there's a number of ways of looking at this, Tom. Let's start off with kind of how he looks and feels. He is much more relaxed. He is much calmer. He has a more positive view of the world than I think I've ever heard from him, Christian Sewing. They've just made an acquisition in London, Numis, that caught a lot of people on the hop, a lot of people by surprise. It was in advisory, it wasn't in wealth. But he's talking about further acquisitions. He definitely feels that he can now put his head above the parapet and take a look at what's going on. But I take you back to the Credit Suisse story. Where was the next place that everybody looked when the Credit Suisse story started to develop and gain momentum? It was at Deutsche Bank, and we had that day when Deutsche CDS went crazy and shot higher. Now, he certainly feels a sense of frustration that they are still in that place, but he says, look at what happened in that situation. We got through it. We are a profitable bank. So I think he is pleased with where they are. Is there progress to be made? Absolutely. But they are not the bank they once were. It is a very different bank. It is a more balanced bank, and I think that is the message that Christian Sewing is trying to deliver.
I look, Guy, at the message to deliver, and it has to come with expansion. And what we saw from Numis, our American audience doesn't know Numis. What is Numis, and what does it mean?
So this is what they were buying with Numis, which is a big corporate bank in London, big corporate house in London. They're buying a huge number of corporate relationships. And this is where Sewing wants to take the bank. He talks about the house bank. This has been his strategy from the get-go. The trading side of the business, he wants to downgrade that. He wants to upgrade and balance out these two sides on the corporate side. That is the bank that he wants to become. So Numis fits with that strategy in so many ways. But the trading side, Tom, has carried this business through the last few years. That FIG business has delivered significant profits, which is why when James von Moltke, the CFO, got up the other day and talks about the fact that he sees 15 to 20% downside in Q2, everybody sat up and paid attention because they're really good on the FIG side. And the fact that they were seeing that, everybody was wondering whether or not they could extrapolate that into the full year. He says he doesn't think so.
Guy, does he think that higher rates in the Euro region are good for European banks?
They have been. At some point, he said the net interest income tailwind that they have received from higher rates will start to fade, and that's when maybe you do get the more balanced approach. So yes, it has helped. Negative rates, Lisa, were terrible for Eurozone banks. I think everybody in the banking sector is glad that that situation has gone away. However, look at what's happened today. Today has been a hugely volatile macro day. You guys have been talking about what's happening with the Bank of England. We saw the Norge Bank earlier, the SNB, delivering a hawkish 25. The expectation that Q2 was going to be a little bit weaker after the debt ceiling, all that sort of stuff. I think what they're saying is that they think the volatility that we're seeing in macro is going to continue and it's going to come back. So the second half of the year is likely to be a better environment for that FIG business to operate in, and maybe Q2 was a blip.
You know, we don't talk about this often with Deutsche Bank, but back in 2019, they cut 18,000 jobs and said that they were exiting global equities. They've made a big retrenchment, and now they're looking at trading as carrying the day and continuing to produce profits. How do you square that? What does that mean? What's the message for other banks in terms of what kind of footprint, the size, the nature they have to make bank in trading?
You've got to be substantial. Equities has been parts. FIC is where this bank has been incredibly strong, and they've been very good at it, and they've delivered significant profits from it, and that has helped them through this period. That's not the model that Sewing is looking at. That's not where he wants this bank to be. He is looking at a more capital-light model. He is looking at a less volatile model. And back to Tom's point just a few moments ago about what rating is Deutsche ultimately going to be on, investment banking, trading is a lower rated business because of the volatility that comes with it. He wants to take the bank away from it and therefore by extension maybe deliver for Deutsche and its shareholders a higher rating. And I think that's the direction of travel here that Sewing wants to take this bank in.
Guy, I want to give you a victory lap on a really interesting Paris air show, certainly the most interesting for me way since the pandemic. I just thought it was fascinating. The size, the number of orders. You spoke with the chief executive officer of Toulouse Airbus. Airbus seems to be real competition for Boeing. Who's winning that battle right now? Who has a technological lead, Airbus or Boeing?
When people compare Boeing and Airbus, in some ways they're not comparing apples with apples, Tom. Boeing has been very strong in wide bodies and continues to be very strong in wide bodies. Airbus has, and it was John Leahy who made this decision when he was Chief Commercial Officer, the success of the A320 family has been enormous for Airbus. And as we saw markets opening up, that narrow body market has become huge. And that's where Boeing has struggled with the 737. But the Boeing still has strength in wide bodies. And I think that's where it gets really interesting. Boeing has had a really tough time. Look at the news out of Spirit. Spirit is going on strike. The staff over at Spirit have rejected an offer that unions backed. Boeing is having a really tough time with a number of different issues. They're both facing different challenges. I would argue in the narrow bodies, Airbus has been the clear winner. But Tom, if you try and pull these conversations together. My takeaway from the Paris Air Show was that demand is still absolutely sensational at the moment.
Right.
You then plug that back into the central bank story, the Bank of England today. It is an economy that it sees as being stronger. The consumer is still stronger. Jay Powell has talked about that. We've seen it in the data. And then you plug it in, that macro volatility into Deutsche. These are how these stories connect. But the takeaway from all of them, I think, is that the economy is actually in relatively good shape, and that's something that central banks still have to lean in on.
Guy Johnson, thank you so much. In London at Queen Victoria Street. Lisa, I look at this and I take what Guy says there, frankly, your analysis of it as well, and I bring it over to the Bloomberg Launchpad, equities, bonds, currencies, commodities, and there's one number, it's the elephant in the room, and that is the recession indicator. 2's10 spread is at 100 basis points right now. The two-year yield, folks, is 1 full percentage point, 1.00 bigger than the 10-year yield. That's undoable in the Tom Keene textbook.
It's climbing back to the levels that were the most inverted going back to 1981. Typically, the telltale sign of recession at some point, maybe in 18 months, but we've been seeing this for a while. What I'm also watching is real yields, basically inflation-adjusted expectations of the yield that you're going to get, 2.7% on 2-year. That is the most going back, I believe, to before the great financial crisis. So we're looking right now, the highest going back to February of 2009. So at a certain point, are we looking at restraint in the financial markets that potentially is more significant and accelerating?
It's a huge point of tension here. And again, I'm going to show oil threatened here. I don't know where oil fits into this discussion, but nevertheless, the fact is off Switzerland, Norway, and the United Kingdom on recession worries, I guess, 71.10 down $1.43 on West Texas.
The biggest mystery as we head into the 10 a.m. second day of Chair Powell's testimony in front of the Senate today.
Will it change today?
Well, I mean, we heard a pretty hawkish tone yesterday, and yet this is sort of the offset. Atlanta Fed President Raphael Bostic coming out with comments that were much more dovish. He really was the one who wanted to stay on hold. He said, "We have good reasons to expect our policy tightening will be increasingly effective in coming months, which would accelerate progress to that end," meaning reducing inflation. This idea that the longer that you extend the x-axis of 5% or 5.5% rates, the more pain you inflict on an economy. That is the mystery underpinning the U.S. picture and the distinction with Europe.
Please stay with us. It is a fascinating day out there. Turkish lira through 24.20. Sterling, a 128, then pulls back. We'll have comments from Governor Bailey. U.S. futures at -12. From New York, this is Bloomberg Surveillance.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. but it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
But the bond market screaming recession. On the other hand, the equity market saying the Fed's not going to be able to do what they want to do.
I think the Fed is going to be torn between stability, their goals of trying to raise short rates, and yet providing liquidity.
How much tightening do they need to put into the economy? How much do they have to dampen down on demand in order to get inflation under control?
We're really looking at an economic malaise more or less than a recession on the horizon.
We're heading into an environment where 2 to 3% inflation, in our view, will become the norm.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Everyone's hawkish today. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John Farrow is on vacation. He will be back after a couple of weeks, and it will be a good and wonderful thing. But I start on this idea that we've heard from central banks. I'm just going to keep talking over that. They keep hearing from central banks, whether it's the Swiss National Bank, whether it's the Norwegian Bank, or whether just now the Bank of England, or even the Turkish Central Bank. Everyone's taking a hawkish tone. What now does Jay Powell?
It's been a real sea change. We had a day of Tuesday was pretty quiet. Wednesday was quiet. This is not quiet. And I'm sorry, I'm going to sum it up, Lisa, just simply here. It's the sum of all these parts. In hindsight, you say, well, of course, the United Kingdom raised 50 basis points. Of course, should Jerome Powell have raised rates at the last meeting.
And what we're hearing is this tone of exceptionalism in the U.S., not only tech exceptionalism, but also inflation exceptionalism, this idea that it's a different dynamic in the U.S. versus Europe. So how exceptional is the U.S.'s inflation story, or is it the same surprising to the upside that we've seen over in Europe?
I mean, we'll have to see. I mean, there is a difference here, and I think we've covered it well here through the morning, the distinction here between Europe. But what we're really talking about is a potential mindset, and I'm going to give it a broad collar, 5.50%, up to where Adam Posen is making headlines in England this morning, 6.5%. Has anybody even gone above that? We're just banding up the yield structure as we go through June.
And the confusion is just why there has been such resilience, right? Why have we not seen a greater degree of pain more quickly? And that's really one of the big mysteries as we see the housing market rebound, and we're going to get some more housing data at 10 a.m. To me, that is one of the key issues that we keep facing off with, Tom.
I want to bring to you an important story this morning. This is just breaking, and this is Bloomberg News reporting. Our Akshat Rathi, Ari Nader, and Keith Naughton in Detroit. If you are of a certain vintage, as I am, this is stunning. There's no other way to put it. The Ford Motor Company, we spoke to their chief financial officer in recent days, has garnered a $9.2 billion loan from the U.S. Energy Department. The scope and scale of this on this new Manufacturing America. This is Gary Silberg of KPMG. Not since the advent of the auto industry 100 years ago have we seen an investment like this. Lisa, I'm not prepared for this. It's such a sea change.
The goal is for this money to finance the construction of 3 battery factories in the United States. And this goes with their $400 billion project of the U.S. to try to build out some of the tech prowess and the new energy situation versus other nations. There are a lot of questions here. There's the geopolitics of it all. And then there's also the growth of it all, the feasibility as well, because there are a lot of loopholes and things attached to it. But this goes to the whole exceptionalism question. How unique is the U.S. at a time when you have NVIDIA, when you have Tesla, and you have these infusions of cash from the federal government?
We have the perfect guy to talk to about this morning. We're 2 for 2 today. We had Terry Weissman with Turkey blowing up, and Daryl Kroc joining us now from Wells Fargo. And you're right, Lisa, it's American exceptionalism, and that is paramount to what's also undersaid here, which is China owns the battery market.
Right, and that's...
And Republicans and Democrats want to take that market with us. We're making this up as we go. We're ripping up the script. Lisa, bring in Daryl Kroc of Wells Fargo on American exceptionalism.
And we're talking American exceptionalism as equities do have a softer tone for a 4th straight day. But Daryl Kroc is joining us with this feeling that perhaps the U.S. is different. He's president of the Wells Fargo Investment Institute and chief investment officer of Wealth and Investment Management. Do you buy into this, Daryl, that there is a U.S. exceptionalism that keeps your eye and your money focused on the United States?
I don't know that I'd say exceptionalism, but there's absolutely a U.S. bias for investors as they think about it. I mean, the Ford News this morning is all about batteries, right? And that is the constraining factor for the next step higher for the EV market, right? The electric vehicle market. The reality is, to your point earlier, China has owned the chip market and they've owned the battery market, right? And so to dislodge that or to move it to other parts of the world, both from a supply chain standpoint, but just a diversification standpoint, requires a huge amount of investment. And you're seeing that investment today. And those are the companies that are propelling us forward. I was just looking as we were coming in this morning, you know, what most people probably don't understand is if you take the S&P 500 now and you take the NASDAQ 100, they're almost the same index. The top 8 names are identically the same if you go down to them. Literally the same. The only difference is the weighting, right? And they're all the tech names that you all know about, right? So we've conflated this into a world of technology, right? That's what has to win. That's what has to excel for the U.S. exceptionalism argument to continue to work.
To me, so much of this is such an important conversation. Again, folks, if you're just joining, Bloomberg reports that Ford Motor Company, with a loan 3 times larger than GM last year on the battery battle, the lithium battle with China, is well. There's a Daryl Kroc difference here. You were weaned off the fields of Ames, Iowa. Okay, you weren't in 3 zip codes in New York. Now he's at a fancy place. And how come he's at Hudson Yards and we're not? What's that about?
You can come over anytime you want.
We'll do that. We'll do a show from there with you see the copper thing they've got there?
Yes.
Looks like a can opener.
Yes.
Kind of thing.
A vessel.
This is serious stuff. We're not prepared for manufacturing America. It's not little Switzerland. There's something going on here. Are we going to have manufacturing America?
I think you will over time, and you're already seeing, you know, the pandemic really accelerated that on the need to kind of, you know, back up and reshore and get your supply chain more secure, if you will. I mean, what's interesting is, you know, we're having a great debate even within our strategy committee about the recovery, the not recovery, and what's happening here. And if you look at industrials are quietly doing very, very well. Why? Well, some of that is the reshoring and the reindustrialization of America. Some of it is the Infrastructure Act. I mean, I travel the country all over the place in the U.S., and I can't go to an airport without it being fully under construction. Any airport, right? Doesn't matter which one I go in and out of, right?
So true.
So where's all that money coming from? Well, it's coming from infrastructure acts and places that capital infusion has happened to try to resurge the economy.
So here's the tension. On one hand, you do have these investments. You do have this promise of new technologies that have caused people to invest more into technology stocks in particular, but stocks more broadly. And on the other hand, you have this fueling inflation and the stickiness that we keep seeing. Which is going to win out? Do you think that we can see a stickiness of inflation and still see almost a haven in stocks because of some of these infusions?
In our opinion, no, right? And I think the key word there, Lisa, that you hit on is stickiness. Because if you track inflation over time, when we've had past inflation bouts, it rises quickly, falls quickly, then trends sideways, and then rises again, right? And I think we're starting to see some of the early signs of that. Look at the housing starts and the permits yesterday, right? The housing data we saw, right? That's 25% of core CPI. We already know core CPI is at 5.3% annualized, way over where the Fed wants to be, right? If you continue to have labor market strength, if you want to call it that, services strength, right? All that feeds into the core. That's way too high for the Fed, right? Even though the headline number is going to come down, there's no doubt about it, right? We'll probably see in June and July the headline CPI with maybe a 2 in front of it, right? It's entirely possible.
Would you feel comfortable going into longer-term bonds at a time when some people are asking, has the Fed lost credibility? We've been talking this morning about central bank credibility.
Yeah.
Inflation is sticky in certain pockets. Core CPI still very high relative to the goal. And yet we saw this pause and pretty confusing rhetoric. Is that a concern?
So we went favorable long duration or long-term bonds in October of last year when the 10-year was at 4.25. That was a great trade. It ran all the way down to basically 3.25. We're back to 3.75 today. Anywhere above kind of 3.80, 3.90, 4%, we think is a good value on the long side of the equation. The interesting thing is, even if you give the Fed credence and credibility for 2% inflation, let's just give them that number, right? The reality is if you give them 2% inflation, 3.75 on the 10-year is still too low by any historical measure of how you would gauge the 10-year relative to a normal inflation regime. Go back and track it in history. Right. It should be higher than that, right? So why is it not? Some of it is concern about the inverted yield curve and the flight to quality that's happened. But we were inverted by 100 basis points, you referenced earlier, Tom, by maybe a day and a half in March, right, quickly, and then we lost it, right? We went all the way down to 40 basis points. Now we're right back there again. The bond market is just screaming that tougher times lie ahead.
Daryl Cronk, I want you to talk in this huge announcement by Ford of $9 billion to take on the Chinese and batteries. The fact is the Wells Fargo heritage is a rutted trail across this nation. That's the imagery. Right. Have you seen the Stagecoach? I've never been in the Stagecoach.
There's one at Hudson Yards.
There's one at Hudson Yards. Should we go? We do the remote. Yes. We can do the remote from inside the Stagecoach. You can sit up on top of the horses.
Thank you.
We'll bring the horses
Anything else
in as well.
Before?
The heritage and branding of Wells Fargo is about this nation from sea to shining sea. I want you to talk to the people scared stiff in cash with a 3, a 5, or dare I say a 10-year view. How should they perceive American investment?
Well, I think American investment is very strong. I wouldn't be wildly overinvested in cash here today. We do think there's good opportunities. I will tell you, we're not seeing those opportunities as robustly in the equity markets today. We see them more robustly in the fixed income markets. We actually think, a little bit to your point, that you're in a Super Bowl market for commodities, a long-term bull for commodities on just a global undersupply across the board.
Can you be long energy, including big oil in America?
We're most favorable right now on energy as a place to be. It's down 10% today. The dispersion between the best and worst performing sectors, tech up 40, energy down 10, right, is 50% as we cross mid-year right now. That's a good value right now. Energy, I'm getting I'm getting 8 to 9 multiples with a 3.5% dividend. I'll take that valuation all day long.
We have to run. Daryl Cronk, well-timed with Wells Fargo. The Standard & Poor's, the percentage move, 0.3%.
The idea of some of these loans and the fiscal spending, I think, dovetails pretty well into what we've been talking about all morning. Is there a conflict right now, Tom, between the fiscal impulse and the monetary impulse? Can you get growth and reduce inflation at the same time? Can there be some sort of soft landing, or does there have to be a trade-off at some point, even if it hasn't come yet?
I gave a speech last night, and the first thing I opened with was a disaggregation of America, like we talked to Sri and with Aberdeen earlier this morning about the disaggregation in the United Kingdom. It's about the haves and the have-nots. You see this Ford announcement, and I go back to there's got to be winners within that. There's got to be winners within the fancy people of the Bloomberg surveillance world and others across this nation, but there's got to be also a lot of technological losers as well, and that's the political battle.
Well, giveth and taketh, right? Because on one hand, you've got the giveth of the loan, and we don't know exactly what the parameters are attached to it. Again, just
come on, the parameters are to beat the Chinese. The Chinese have X% of the lithium battery market, and we're scared stiff.
But a lot of people talked about some of the strings attached to some of these loans and some of these government programs that do make it a little bit more complicated. On the flip side, the student loan issue, I do think is important, and I don't think that we can drop it. The fact that suddenly people are going to have to start paying again for the first time in 3 years, and that's going to start in October, and that could mean, you know, $300 of disposable income that's going out the window after all these other loans have been incurred by the consumers. I think it's significant.
What do you say to all the people that paid their loans along the way? You know,
congratulations, but there still are $1 trillion of people who have it, more than that.
The size of it is, the scope and scale is amazing. My head's spinning over what's going on today. Turkish lira at 24.23, sterling 127.70. Michael Gapin with us in a bit. This is Bloomberg.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Exclusive today. Ukrainian Prime Minister Denis Shmyhal sits down with Bloomberg's Maria Tadeo. Live from the Ukraine Recovery Conference in London. Only on Bloomberg, your global business authority.
Very far from our inflation target of 2%. We are strongly committed to getting inflation back down to 2% over time. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. Earlier in the process, speed was very important. It's not very important now. Given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace.
Jerome Powell, on script there, Michael McKee said he really storylines behind the data check to encapsulate a Thursday claims. This is the first time we've mentioned claims in 12 minutes. That shows you the topsy-turvy day it's been. I'm going to go through equities, and Lisa, pick it up with your story du jour. Futures negative 11, Dow futures negative 88, the VIX 13.81. I'm going to call it a fractional weight to the tape after 2 days of struggle. Lisa, what do you see?
Well, just a grind higher in the front end across the world, frankly. You can see that in the United Kingdom with two-year yields near the highest levels going back to 2008. And you can see that in the U.S., where you have two-year yields grinding to the highest levels versus 10-year yields going back decades, at least getting close to that level. What I'm also watching, though, is the pound. And to me, this tells a very significant story, the pound versus the dollar. We have reclaimed a bit of strength, 127.82. But if we don't see more strength, what does that say about the credibility of the Bank of England after delivering a bigger than expected rate hike of 50 basis points?
As Mark Chandler said, for longer. And that it doesn't matter really the level. Every country, Norway has a different story than Switzerland and the United Kingdom and others. But it's just simply put, we're readdressing for longer today across so much of what we look at in the fixed income space. We should mention Turkey with some announcements on what some would say is proper policy, but maybe not enough. Even with those announcements by Mr. Semsek and the central bank, Turkish lira breaches 24, which is a huge deal. 25 is unimaginable. Lira 24.23. It seems odd and out there, but maybe it's a little bit of the emerging market angst off of interest rates higher for longer. I'm exhausted by this. We need a brief. Ira Jersey to the rescue, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, how does your world change if all of a sudden rates are higher for longer?
Well, we've been calling for the not necessarily the higher, but certainly the longer for most of this year. And that was one of the biggest mispricings in the market, was the idea that we were going to have significant rate cuts this year because of inflation coming down. So I think that, now we've completely priced it out of the market. You saw this morning from the Bank of England, a 50 basis point hike that wasn't fully priced into the market. So you're seeing a lot of that bear flattening of the yield curve in both Europe and the UK. And there's the risk that can get even more acute there. I think the U.S. is a bit in front of this. Like the U.S. is a little bit closer to the end. Like even if you look at the dots, you're talking about one or two more 25 basis point hikes, whereas in England you can wind up still with another potentially 50 to 100 basis points of hikes.
Ira, you and among others, Priya Misra, absolutely nailed the further inversion scope. It was 40 basis points. 60 was unthinkable, 80 was an oddity said by strange people like you, and you had the courage, I remember, to go out to 100 basis points. What does 100 basis point inversion mean to our mortgage industry, to our banking industry, to something as basic as net interest margin?
Yeah. Well, for mortgages, it's not that big of a deal, really, because you still have 10-year yields, 7-year yields, under 4%. So really, that's what is the spread on mortgages, and that's being affected by different Fed policy. That's being affected quite a lot by Fed runoff. But for the banking sector, I think it is pretty. There's kind of a haves and have-nots. So the large financial institutions that have a lot of bank reserves, they're getting paid interest on those reserves. So one of the things that you've seen over the last year and a half is actually net interest margins for some of the larger institutions actually go up, because of the fact that they could take advantage of the Federal Reserve paying interest on these reserves while they're not paying on deposits. So but one of the effects of that is now people have been, particularly this year, and this is one of the issues that became more acute a couple of months ago, is people have been reducing their low interest bearing deposits and going into money market mutual funds. And so that's created kind of a funding issue in some places, and that's continuing. You still see some, not so much, the deposit outflows have slowed, but you still see deposit outflows and money still flowing into money market mutual funds regularly. And that means that you have these supply-demand dynamics in fixed income that really favor the short end right here. And you know, your previous guest mentioned 5% money market yields. That's reasonably attractive, right? If you have a 5% yield, the question is, how long will we stay there? And it seems like we're going to stay at that 5-ish% level for money funds, maybe for the rest of the year and into 2024. So that's not necessarily a terrible place to kind of hide a little bit if you think other markets are going to be volatile.
Well, to that point, we're about 98 minutes away from day 2 of Chair Powell's testimony. There's a real question here about what hawkish means, given that he is sort of doubling down on the message that most members believe that rates should be higher. You said that now the market is perhaps mispricing less the idea of higher for longer. Is it still mispricing that risk? So we could see 5% or 5.5% or even 5.75% Fed funds rates for a considerable amount of time.
So, well, let's say first we have to get to that 5.5%, right? So we do have, you know, another hike is fully priced, not 2 though, which is what the dot plot suggested. So the risk is at some point, maybe if the Fed does hike in July, that we price in potentially another hike. You know, the market right now, the way that if you look at options pricing and what options on short-term interest rates are suggesting to us is that we're going to have interest rates that are at this level into 2024, and then will slowly go down. And then by the end of 2025, interest rates will be around 3%. That's where the Fed funds rate. I think that ultimately we're going to have a much harder landing than what the market's currently priced for. But it's not going to be obvious that we're in that situation probably for another year, at least in our view.
My head's spinning, Ira. I mean, I got one final. I got to take some Tang. Hold on. Tang Zero to calm the mind. Ira, are you saying we're going to have the mother of all recessions because of this interest rate mess we're in?
Well, I don't think it's going to be as bad necessarily as the last 2 recessions, but I do think that we can have a significant slowdown in credit activity. We wind up with an environment where unemployment is, you know, starts to rise, but wages don't necessarily go down. So it winds up looking much different than some of the recessions that we've had over the last 40 years. But you know, when you have I don't want to call it a stagflationary recession, but when you have a recession where inflation is still a bit high and you have a central bank that's reluctant to cut interest rates to fight inflation, you really wind up needing to see, and probably they don't cut until you have a much weaker job market, and it's not obvious that that's going to occur probably until it's almost too late that it will occur.
Ira, thank you so much. Ira Jersey, leading all of our fixed income coverage at Bloomberg Intelligence. He publishes. Look for that on the terminal. Lisa, is your head spinning like my head's spinning?
Well, these are the different nodes of the debate, and this comes at a time when a lot of people are trying to understand what it means if you don't have a central bank response of cutting rates to weakness in the economy. That really hasn't been tested yet. People are just simply gaming out weakness. And that, I think, is really the tension, especially as we see some of these political back and forths in Washington, D.C.
I look at the partition of we were ultra-accommodative, then we were some form of on the edge of restrictive, and I have no clue if we're restrictive now or not. But again, the time duration of this, maybe we're a restrictive point, is fine. Its impact on different parts of society, to me, is the front and center debate.
I take that point just to bring you this and to sort of build on that point. Marco Kalanovic over at JP Morgan coming out with his latest saying, without a significant rate cut, it's hard to see how stocks are going to significantly rally. This is the tension right now underpinning some of the debates.
The future's 43.98. Let's round it up to 4,400 as well. In minutes, we will have a conversation with the Prime Minister of Ukraine, our Maria Tadeo, in London with Denis Shmyhal. This is Bloomberg Surveillance. Good morning.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance. What kind of day it's been? I didn't mention claims until I think 14 minutes ago. That's how interesting the news flow has been. Futures at -11 here. The economic data sort of staggering to the end of the week, but claims, weekly claims, 4-week moving average of claims have been of interest recently. Here to report on claims, our chief claims correspondent, Michael McKee, at Fed National Activity Index as well.
Yeah, the Fed National Activity Index slips a little bit, suggesting a bit of a slowdown in May. I wish I could claim to have the number of claims, but so far it is a little bit delayed coming down the pike. We'll have it for you as soon as we can.
Do you have a number in your head which validates the economic slowdown theory, the cracking of our labor market?
I think, well, when you look at the numbers, you have to get up close to 300,000 to match where we were in previous recessions, leave the pandemic behind. Okay, here we go. 264,000, which is a small increase over the 262,000 that had been reported a week ago, still waiting for the revisions. The market had expected 259,000, so not a big change. And as I said, it's still way below where it was last 3 times we went into recessions, excluding the pandemic. 4-week moving average, or actually not 4-week, the continuing claims number, 1,759,000. That's a drop. Oh, and last week's number, revision, 264. So no change at all when the numbers are revised, which is what happened last week. In other words, the claims market is telling us the labor market is still tight, backing up what Jay Powell said yesterday to members of the House.
I look, Mike, at the data coming out, and I guess we've got to prepare for next week as well. Jerome Powell it's a different set of questions today at the Senate, isn't it? What's the question we may want to lean forward and listen for today? Don't tell me it's a dead company.
I'm not sure anybody in the Senate is as big a deadhead as some members of the House, but we'll find out. Now, the interesting thing about yesterday, Tom, was that it was much less political than a House hearing usually is. Clearly, the banking lobby had put a lot of questions to the members of the House because a lot of questions were on bank regulation and probably more than there were on monetary policy. But there weren't many of the don't you think Joe Biden is the worst person in the world kind of questions from the Republicans, and don't you think Republicans are terrible for the economy from Democrats. You usually get that at the House, and you didn't. So I'm not sure we'll see a whole big change today. Probably any news that was made yesterday, and the message was, we're not done. We're going to raise rates, and the market took it as no change from what we went into this with.
Before we let you go, I am curious to put this all together. We've heard throughout today there is a hawkish tilt at a lot of the central banks, certainly over in Europe. people saying the U.S. is different, that inflation isn't as sticky as it is in Europe, that it's not going to surprise to the upside, that you are seeing a deterioration and that it can be a soft landing. Is the data backing that up? Are we seeing some of the unemployment ticking higher with a softness and an ease that can lower inflation without having to materially cause some significant recession?
You're seeing 50-50. I mean, you saw the tremendous jump in housing starts this week, and yet we've seen consumer confidence a little bit stronger, not a whole lot. Retail sales are hanging in there, but they have slowed in general. So the overall economy in the U.S. is kind of in a middle spot. And I was telling somebody yesterday, you could get Neil Dutta in here, and you could get anyone a number of doves, and you could have a nice food fight over whether the economy is going to do that. The thing that you're right about, Lisa, though, is that central banks are increasingly, they're going the same direction, but for divergent reasons. The U.S. has still got an inflation problem, but talking about slowing its rate process. England has an inflation problem that's really bad, and so they're talking about speeding it up. Norway today raised by 50 basis points because they're worried about their currency. The Swiss say they're almost done. The Chinese are cutting rates. So it's going to be an interesting time and divergence around the world, and we'll see where growth goes because of that.
Michael McKee, thank you so much for running all of our economic coverage this morning. We turn to Michael Gapin, Head of Economics, Bank of America Securities. Michael, my head's spinning. There's so many trends going on here, and as Mike perfectly encapsulated, the ambiguities of the moment are immense. What is the thing at the margin you're studying subject to change about American economics? What's the part of the story that interests you?
I think there's two parts. One is what Lisa mentioned. How quickly can inflation come down even in an environment where the labor market is extremely tight, per Powell's words? So can we get further diminishment in goods prices, used car prices, shelter inflation, same conversation we've been talking about for some time. But I think the mirror side of that coin, which Powell emphasized yesterday and we and others have been picking up on more, what is the big miss really this year has not come on inflation, it's come in the labor market, where the labor force has rebounded extremely rapidly this year. Last year, the shortfall in the labor force from kind of pre-COVID projections was as high as 2 million and not falling. By our estimate, it's down to about 400,000 now. That means the probability of a softer landing or mild recession is higher, and the Fed doesn't have to lean on the labor market as much, perhaps, to bring inflation down. So it's that labor force rebound, from my perspective, that puts the Fed in a very different spot today than it was thinking it was in maybe 6 to 9 months ago.
Michael, how does Fed Chair Jay Powell draw this distinction at a time when his compatriots over across the Atlantic are moving in the opposite direction and are facing resurgent inflation, exactly what they didn't want to see in a Burns-like kind of situation?
I think this is where one time you fall back on the U.S. is a large, relatively closed economy. We're less affected by global trends than is the case elsewhere, and we'll make the decisions on our policy outlook based on where the domestic economy is. The upside risk on inflation in the U.S. will come out of U.S. labor markets and whether there's persistent tightness in the labor market that keeps services inflation elevated. So I think you just kind of fall back on the historical tendencies of the U.S. to be much more domestically focused, services driven, and therefore we're going to set our policy based on that evolution.
The other aspect of the conversation is the fiscal side versus the monetary policy side, and people are talking a lot about the fiscal impulse of having to repay student loans again starting in October. We've been debating this for a couple of days and trying to figure out whether this is an overplayed risk or an underplayed risk. Do you think that the reinstatement of having to pay back your student debt after 3 years of a moratorium is going to have a material impact on both growth and inflation in the United States later this year?
I think we would come down on the side that from a macro perspective, it's unlikely to have a material effect. It should probably dent the strength of spending in, say, September or October, but the magnitude of interest payments is maybe about 0.2% of personal income. If you fold in principal payments, it's closer to maybe 0.5%. So from the macro perspective, we doubt it has a material impact, although certainly at the individual level, it may affect behavior quite a lot. It just doesn't we don't think it adds up to something macro systemic, if you will. So it's probably more about credit markets and the behavior of those as opposed to the macroeconomy more broadly.
What does Bank of America see, Michael Gapin, in your immense ability to tap knowledge on the American consumer? And I want to get granular here. Through the month of June, is there any indication of a slowdown of the American consumer?
Yeah, there is, Tom. There is, and our B of A card data would suggest that consumer spending continues to slow, but at a moderate pace. And when we dig into those details, we do find that, you know, some of the revenge spending categories are starting to show softness. So airlines and lodging, which were really strong last year, those things have started to moderate. But spending on entertainment and recreation, that is still strong. It maps into what we're seeing in the labor market, where 2/3 of your gains in private sector employment are still coming from areas like leisure and hospitality and education and health. So there's still some catch-up spending, leading probably to follow through in hiring. But on the margin, it does suggest that spending is moderating. It's about flat on a year-on-year basis, and in some categories moving slightly negative.
Michael, I have to say, I'm hearing all of the noise behind you, and I'm thinking to myself, a lot of people are back in the office, and how different this is than what we have heard for so many years. Is that your experience, that this has actually been this sort of sea change or reversion, and the whole like work from home trend has kind of died out?
I think that's very industry specific and probably job requirement specific, where, you know, I'm in at least 4 days a week. Sales and trading here is in 5 days a week. So certain roles are definitely back in the office. I see it on my regular commute as well. So, and certainly Monday, Tuesday, and Wednesday, Tuesday, Wednesday, and Thursday are your big peak days. So yeah, there's kind of 3 out of the 5 days it's feeling, quote, normal. And then it kind of tapers off as the week goes on.
You know, Friday at Bank of America, Moynihan's out at the summer place, Gapin's in with shorts and flip-flops.
That's a celebration of the
scary
fifth day.
thought. A
scary thought. Michael Gapin, thank you so much with Bank of America as well. I was downtown last night, not downtown. Let me correct that. I was midtown last night. Getting below 59th Street is downtown. And I was shocked how busy and buoyant a Wednesday is in New York City. We just got to get the Wednesday to the Friday. And that's the great challenge for a lot of business people.
Well, if you go past 59th Street and then a little further still, on the weekends it's quite crowded as well. I will just say that you are seeing a real resurgence of the city center. And this has been one of the complaints about why people aren't coming back to the office from some of the executives, saying you can go out to eat, and they are. A lot of people coming back.
Yeah, but I just wonder, how do we get from a buoyant Wednesday, as you mentioned correctly, the noise, the fervor there at Bank of America on a Thursday, but what's Friday? What's Friday look like? You and I and John are the only ones that are here, you know, with our staff. I mean, Amy takes off about every 4 out of 5 Fridays. I mean, you know, that's what she's doing.
There's a real reset. I was actually looking at some research over the past couple of days about how the listings for remote work have completely fallen off a cliff, that basically the whole experiment isn't necessarily being fulfilled in terms of what employees want to see.
Yeah, it's going to be interesting to see. Got an improvement in the tape here, still -7 on Standard & Poor's 500, but nevertheless a bit of a lift to the tape. The cross currents, folks, are fascinating, starting with 110 euro. Sterling with a 128 print over the shock of that 50 basis point move. Thank you to Lizzie Burden for her coverage from London. Standard & Poor's 500 now down 0.2%.
Coming up on the Open, Alessio DeLongis of Invesco will be joining me. I am filling in for John Farrow yet again, and Megan Robson of BNP Paribas, and Mark Heffley of UBS, which will be fantastic to have him on. I'm really curious to understand these upside surprises to the rate hikes around the world, the Bank of England leading the charge, as well as the Norwegian Central Bank, what this indicates for the nature of inflation going forward. Have we fully appreciated the stickiness at a time when you are seeing an Arthur Burnsian kind of reversal from perhaps we don't need to do that more to we need to do a lot more?
I think it's going to be, you know, interesting to see. I just don't have any strong opinion. I wonder if we're going to see in the next 24 hours, folks, some research navel gazing and saying, you know what, Jerome Powell should have raised rates. to keep up with the others. I really wonder if that's going to be part of what we see.
Well, he actually had some details on that. He basically said that they are probably going to raise rates further. He did double down on that hawkishness. What he said was it matters less the pace. That speed matters less after how quickly they've raised rates. Whether people buy it or not remains to be seen. Right now in markets, you are seeing a credibility from the Fed that you're not seeing with the Turkish central bank, certainly, because people are expecting them to get inflation under control, as you can see from the longer end of the yield curve.
You know, Francine emails in. She says, well, John, you know, he's in Ischia. I think that's how you pronounce it. He was in Capri, and now he's in, I think I'm pronouncing this right, Ischia.
Is that what you were looking
Ischia.
up while I was talking?
The rabbits, John's having the rabbit stew there at La Portobello, it's called. You know, it's island to island. On assignment, Jonathan Farrow. Futures at -9, Dow futures at -72, the 10-year yield 3.74%. Stay with us. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
City, from London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
It's clear that in the EU we should continue to build on our strengths of being open economy, of being a trading superpower, but at the same time there are certain economic security concerns which we need to address in a more conflictual global geopolitical environment.
One of the most interesting voices on continental Europe, Valdis Dombrovskis, is a former prime minister. He is executive VP for trade for the European Commission, I should say. He's really been helpful with Bloomberg surveillance over the years. We love at our global audience, and particularly our audience in continental Europe, who thinks nothing of flying down to Ischia. I said Ischia because I didn't know which island Farrow was on, Mike McKee. And it's Ischia. Thank you to Oppenheimer and Company and BNP Paribas Paris for correcting my fractured Italian. This happens.
We can't send you.
He's on assignment. I mean, I can't go. But
assignment,
he does it better than we do. You and I don't do this like
well, that's because he
vacation.
follows Italian.
Yeah,
So,
you know, he's in Capri one day and Ischia the next day. Thank you so much. Frank, thank you for emailing in as well. You know, nobody sends me any emails about Powell policy. It's about where Farrow is, which island he's on as well. We're waiting right now for an interview with our Maria Tadeo with the Prime Minister of Ukraine. We'll bring that to you as we can. But quickly here, Michael McKee with us. Is the war in Ukraine affecting the American economy?
It is at the margins. It had a big effect in the beginning because, of course, energy prices went up, and we also saw agricultural prices go up because of the agricultural exports from Ukraine that weren't getting out. Now, a lot of that has eased. Where you're seeing it a little bit now, particularly, is in defense spending. We've sent so much armaments to Ukraine that they have to be replaced, and so we're seeing defense spending rising, which is something that's going to add to GDP. Brings up a debate on Capitol Hill, of course, about spending levels, but Congress has always hid defense spending in these continuing resolutions and off budget. So I imagine it's not going to. I imagine it'll be the same this time.
The Prime Minister of Ukraine is a most interesting guy with many different public duties over the years, but all working around trade and the economy of a pre-war and at present war in Ukraine. In London, our Maria Tadeo in conversation with Denis Shmihal.
Tom, good morning, and we are joined by Ukraine's Prime Minister, Mr. Michal. Thank you so much for being with us. We've seen each other in many conferences like this multiple times, and I know how difficult it is for you to get here. It's this train from Ukraine, very big country, over to Poland, and then a lot of security concerns about your staff, your team, yourself, so we appreciate your time. And one of the things that you always tell me is, when I come to a recovery conference like this, and there's been many, I do feel our allies say we stand with Ukraine, and they mean it. But a war is long, it's expensive. Did you feel any fatigue in this runaround?
Thank you so much for the invitation. It's a pleasure to be here with you and morning. So it's second conference for Ukrainian recovery. First one was held in Switzerland 1 year ago. Today we are in London. 62 countries and international organizations are here. Hundreds of businesses are here, international businesses. We feel tremendous support from all of our partners. We feel financial support, sanctional, military support, humanitarian support. Results of this conference have a long-term consequences. We have many promises. We have many concrete agreements, declarations, memorandums. We have financial support. We have middle-term program for Ukrainian support from European Commission, from European Union for 50 billion euro for the next 4 years. We have tremendous support from United Kingdom. We have very good meetings with our partners and with United States Secretary of State. We have very good conversations, negotiations, and very good results.
And yet, while all of this is happening, we know that back home the fighting continues and the counteroffensive is going. And I do want to make something very clear. Was there at any point in this conference, did you get any hint that anyone suggested the funding will depend on the counteroffensive?
Absolutely no.
If it's successful, more money. If it's not, it would be less. No one told you that.
We have very, very sustainable, very strong, and very unwavering support from our partners. There is no dependence from results on the battlefield.
They are entirely different.
Absolutely. We have very strong messages, especially on that conference. Ukraine is future member of EU. Ukraine will be supported by partners. Russia must pay because of these consequences of this war, of terrible war and aggression from Russia's side. So these messages from partners are very supportive, are very promising, and now we continue our counteroffensive. This is not easy walk. This is not Hollywood movie, as our president Volodymyr Zelensky said yesterday.
Yesterday, he seemed a little bit exasperated. This is not a movie. It takes time. It takes patience. Absolutely. Is that what you feel at times too? This is not Hollywood. It's real people and it's lives.
Yes, and every life is very important for us. And we are not Russia. We are not Soviet-style army when they bring their lives to the fire of the war. So we are very careful. We are very smart. We use NATO standards in this war because we are fighting according to NATO standards. We are fighting for weaponry of NATO countries. And counteroffensive, it's multiple operation. It's offensive, it's defensive operations, it's tactical pauses. So it will take time, but we have first results.
It's too early to make an assessment.
Absolutely.
Now, that's what you say.
We have first results of our counteroffensive. 8 villages are liberated. More than 113 square kilometers is liberated. 7 kilometers go into the head from the front line. So it's very important results for the 2 weeks, and we will continue.
And sir, of course, now you have, you're on Bloomberg TV, of course you have the investment community that's watching this interview, but you also have a lot of taxpayers, some of whom are very sympathetic to Ukraine too, but they say we want to see value for money, but also this idea of corruption at times. I remember President Zelensky said, my government will crush the oligarchs. We will be a before and after moment in Ukraine. Is that the moment or the message that you're sending to people? Things are changing in Ukraine.
Ukraine is changing, absolutely. President, our government, we have zero tolerance to the corruption.
You will ditch people that are corrupted if you find anyone.
We finished formation and creation of our anti-corruptional infrastructure together with our partners. We are absolutely transparent, accountable, and open. And this anti-corruptional infrastructure is working now, and we demonstrate to all the world that we are fighting with a corruption country. And we will have results. We continue our reforms, we continue digitalization, we take off state and public services from persons and go to the digital space, and this is very, very effective way to fight corruption. Just don't let people to be corrupted, because digitalization brings new technologies and new possibilities.
And can I ask you, your meeting with Mr. Blinken, the U.S. Secretary of State, he was here, and I know you had a one-to-one meeting. There's an election coming up in the United States. Is that something that worries you, or did he tell you the United States is in for the long haul? This is about values for the U.S.
United States is very important partner, is the biggest supporter for Ukraine. So we discussed all the important issues. We discussed, first of all, financial support, and Mr. Blinken announced the next $1.3 billion support, financial support for Ukraine, for our reforms, for our recovery, for our energy sector. It's very important for us. We also discuss all other issues, very important in sense of development of my country despite the war. Demining activity, sanctions against Russia, development of energy sector in Ukraine, and many other very important issues. So
the meeting went well, and I also wonder, however, with the average American that may be watching this too, and is thinking, but Ukraine is a far way off. I don't know anything about this country. What's going on there with my money? What's your message? What would you say? And I also wonder, however, with the average American that may be watching this too, and is thinking, but Ukraine is a far way off. I don't know anything about this country. What's going on there with my money? What's your message? What would you say? Stay with us because what?
First of all, we are very grateful to American people, to United Kingdom people, to all our partners who support us military, financially, by sanctions. It's crucially important because we are fighting not only for our land, for our families, for our people. We are fighting for democratic and for civilized values. It's crucial. And because of this, all democratic world support Ukraine. Why? Because this is about global security system. And it's very important, don't let any aggressor to have a free thinking about future possible aggression.
If Russia were to win this, and it's a hypothetical, then would you say it would be the moral collapse of the West? If we let that happen, it would be the moral collapse of the West.
I think that...
You don't even contemplate Russia winning?
It's impossible. It's impossible, and I think that I'm sure that civilized world will not let Russia win this war, because it's about existential things. It's about the world security system. And from my side, I should say that Ukrainians have no intention, no imagination that we may lose this war, because it's about our existence. It's war with war crimes, with war against humanity, with genocide against Ukrainian nation. So if Russia will win this war, it will mean that Ukraine and Ukrainian nation is not exist anymore. So from our side, we understand that we will liberate our country in the borders as on the 1991.
And it is existential. That's a word I heard the most the last time I was in Ukraine, that this was existential for the country now. And I want to ask you, however, another existential question perhaps is the NATO summit. You said in this conference, for a strong economy, you need a strong country, and that means security. What's going to happen in that meeting? President Zelensky said, my people have shed blood for a timeline now to NATO. What's going to happen in a month's time in that meeting?
I may repeat, we are fighting according NATO standards. We are fighting by weaponry of NATO.
So why is it so scary for some?
In fact, our army is NATO army right now. We are fighting for the same principles for which NATO was created. So I'm sure that membership of Ukraine in NATO, it will be a very win-win situation, very mutually beneficial situation. So we are waiting so that this summit in Vilnius will be a very strong summit, and we will hear very concrete and very strong messages about Ukrainian membership in NATO. And we hope that partners will do this. We have 20 allies which are supporting Ukraine, which signed some declarations. We discussed with some skeptical allies, but we have sure inside of our hearts that everything will be good.
And very briefly, sometimes you hear people say, just sit down and talk to Vladimir Putin. When you hear the name Vladimir Putin, does it trigger anything in you, or you just go, this is in the past, I'm not interested in Vladimir Putin?
Putin is the biggest crimer of our times, of 21st century. We don't believe that he may do something to bring peace in Ukraine. So only his step to stop shot and take off Russian army from Ukrainian territory may stop this war and bring peace back on the European continent. But he has this possibility since 214. So we understand that this is now impossible.
And for you, you say it's now impossible. It's too late. Prime Minister, thank you so much. Appreciate it. Always very good to see you in Bloomberg. And thank you for being here with us in London. Thanks.
Thank you so much.
Tom?
Maria Tadeo, thank you so much for a piercing conversation ending with comments of Ukraine on the leader of Russia. Futures at -11, Dow futures at -85. This has been an extraordinary day. I have to say to the team, I think we blew up the show 3 times to bring you experts on these issues. Stay with us. This is Bloomberg. Good morning.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. Day 4 of softness in U.S. equities as they digest hawkish prognostications from central banks around the world. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, stocks slump as central banks worldwide take a hawkish stance. Chair Powell doubling down on more rate hikes this year. And Prime Minister Modi heading to Washington as the U.S. and India look to improve economic ties. We begin with the big issue. The hawkish surprises keep on coming.
This is clearly a hawkish tone from the UK and from Norway.
We're facing still, globally, a serious inflation problem.
Central banks that have not quite done enough to bring down inflation.
Wage growth is still stronger than central banks would want to see it.
Central banks started out well behind the curve.
The Fed continues to tighten and remain hawkish.
This is the most hawkish pause I could have imagined.
The ECB does seem more hawkish than the Fed.
They're going to have to sound quite hawkish.
The need to tighten continues.
The U.S. economy continues to surprise to the upside.
A really solid economy.
We still have a long way to go on the inflation front.
Core inflation is above where it should be.
That's going to keep the Fed in this relatively hawkish tone for a while.
These central banks around the world have to continue to tighten.
They're catching up, but they have a lot of work still to do.
This is the key question. How far do rates have to go, and just how sticky is inflation globally? Joining us now to discuss, Invesco's Alessio DeLongis and Megan Robson of BNP Paribas. Megan, I want to start with you. How much are you resetting your expectations for inflation, given what we've seen in the UK, given what we've seen in the Euro region, and given the response from central banks?
So on our side at BNP, we do expect inflation to be sticky. So we're calling for one more rate hike in July and for the Fed to remain on hold for the rest of the year. For credit markets, I think what's very interesting as they've been very resilient despite this more hawkish message. We've seen credit actually hold in very well over the last week. we think what's going to drive markets for the second half is going to be the data. So, to the jobless claims we saw earlier today, we are expecting to see some softer data heading into the second half, and we think that's a catalyst for credit spreads to move wider as some of the tightening starts to filter through the system.
Alessio, do you think that the chances of a soft landing are higher or lower after what we've heard over the past couple of days with central banks globally ratcheting interest rates higher and the U.S. likely to do the same?
I think what we're learning is that it's really a time shift in that recession or soft landing, so to speak. I think for 2023, we can certainly talk about more of a soft landing. What we're learning through this policy cycle is that the level of the real rate that really leads to a slower inflation down to target, to levels that are consistent with target is a lot higher than we would have ever expected. Real rates are now at 2.7, 3% in the developed world, which is something, especially in the short end of the curve, at 3% real rate is something that was unimaginable only a few quarters ago. But what that is doing is postponing that slowdown, and is postponing also the magnitude of that slowdown, the timing and the magnitude of that slowdown. When you look at the dot plot, it's implying over 100 basis points of cuts into 2024 and another 100 into 2025. Similar dynamics you're seeing in yield curves around the world. So it's really a question of softer landing today or no landing today, as the economy is just cruising along a low growth rate, below trend, but absolutely just fine, and a postponement of that deceleration 2 years out, I would say.
2 years out, Alessio, and this is where I want to double down. Do we have a sense of what to look for to understand the long and variable lags versus just the insensitivity to interest rates, right? I mean, it's a distinction, and it's one that Fed officials are trying to make. What are you looking at to understand the length of this delay of the long and the variable lags that will eventually, in your view, catch up with the economy?
Great question. The lags historically have been between 1 and 2 years. Let's call it 18 months to be overly precise, just for the sake of simplicity. So when you look at where the tightening cycle started, that's just barely over a year ago. So by those metrics, we should begin to see the impact of monetary policy just around the end of this year and going into next year. When you look at the relationship between the inversion of the yield curve, the slope of the yield curve globally, and the level of market volatility, we see the 18-month to 2-year lag. The only variable, and I think Megan alluded to this earlier, the only variable that we see has had already an immediate reaction to the monetary policy tightening is the bank lending surveys on financial conditions, on lending standards. But we're not seeing that come through into credit spreads. So I think it's still too early to say that this time is different. I think the lags are still working as we have historically seen them, and that's why the unemployment rate is still at all-time lows. The unemployment rate is still reflecting past monetary easing and fiscal support.
Megan, do you agree with that that's sort of the time frame that you're looking for some of the rate hikes to take effect?
Lisa, we do agree with that. So I think one interesting takeaway from first quarter earnings for high yield corporates is that for the first time this cycle, we've seen interest expense actually growing more quickly than EBITDA. So on a micro level, we're finally in that restrictive territory, name by name, for your average high yield corporate. And so over time, as we expect the Fed to remain on hold, we think that deterioration will start to be more apparent with interest coverage on a downtrend for the rest of this year.
And you think, Megan, that's going to be reflected in spreads widening more considerably, correct?
Yeah, so we're calling for spreads to widen. We think the difference between where fundamentals are today and where we will be later this year will be priced into spreads widening. And to the comment on tighter bank lending conditions, yes, spreads are not pricing that in, but we do see it in the primary market. So If you look at high yield issuance, much lower this year. It's mostly been refinancings, not a lot of appetite for M&A and LBO, and you have seen a pickup in secured issuance. All those signals tell you that credit conditions are tightening. It's happening slowly, and we think it's a matter of time before that is priced in.
This is the tension right now. What happens if the Fed does keep rates where they are, not perhaps even hike that much more, but not drop them lower? JP Morgan's Marco Klanovic talking about this, seeing U.S. stocks struggling without a Fed cut, writing, quote, in equities absent preemptive Fed easing versus Fed dots that imply 2 more hikes by year end, we expect a more challenging macro backdrop for stocks in the second half with softening consumer trends at a time when equities have re-rated sharply. Alessio DeLongis, there's a curiosity here, and Megan was alluding to this, certainly in the credit sphere, that you are going to see a reflection of this tighter policy more and more as time goes on. Is that true as well for the equity component, that they will wake up to higher rates more significantly later in the year?
Absolutely, and I think if you look under the surface, equities have already behaved accordingly. It's true that the overall equity market has posted very attractive double-digit returns, but when you look under the surface, this was all led by a very narrow market, very narrow leadership in quality mega-cap names. That is a defensive rally. It's a rally that needs to be respected, but it's a rally that is not validating an economic recovery. It's a defensive rally driven by quality and low volatility names, mega cap names, while when you look at the lag, the underperformance in value, in small and mid caps, in emerging market equities, these are all the cyclical, more economic bellwether indications of the equity market. So I think the type of environment that we're seeing into the remainder of the year still justifies because of the low unemployment rate, still a relatively healthy market backdrop, but still led by cautious defensive sectors and styles in the equity market.
Alessio DeLongis, Megan Robson, both of you are sticking with us. I do want to bring this to you, that Bank of England's Andrew Bailey has been speaking. He doesn't have a press conference after his release, but he was speaking to a gaggle of reporters, and he said that he's not trying to trigger a UK recession and that he'll do whatever it takes to cut inflation. Fed Chair Jay Powell has perhaps a similar message when he does head to Capitol Hill for day 2. This time in the Senate, we're going to be hearing from him as he testifies coming up today at 10 a.m. Eastern. Joining us now is Michael McKee for more on what to expect. Mike, what are you looking for today?
Not a whole lot different, Lisa. This is going to be a chance maybe, though, for him to explain the difference between a skip and a pause and what the Fed is looking for in terms of how it makes its determination on whether it's going to raise rates again and when. Jobless claims today, an interesting case. They are up by 2,000 to 264,000 from the initial report last week, but that was revised up to 264. So basically jobless claims unchanged. Doesn't look like there's any kind of mass layoffs going on, especially when you look at continuing claims. They fall. And if people were getting benefits, that number should be rising. So the Fed is looking at the labor market and saying this is still pretty strong. Now, yesterday, Powell told members of the House Financial Services Committee the process of getting inflation back down to 2% has a long way to go. In other words, we're going to raise rates. Austin Goolsbee, who had been one of the biggest doves, saying he's not decided what the rate decision should be because the meeting's more than a month from now. Raphael Bostic, who is not a voter this year, but still came out yesterday and said the bar to justify further rate hikes is higher than it was a few months ago. So the Fed hasn't made a decision on what it's going to do in July. The chairman hinting they will, Bostic hinting they are still quite divided. Markets have made their bet, though. The markets are betting on a recession and Fed rate cuts sometime down the road. It's not showing up in Fed funds futures, but I know you've talked about this earlier today, Lisa, the yield curve giving us a very strong message. It's the most inverted since Paul Volcker was in the 20th and C Street Fed chairman's office, and we were going into a huge recession there. And every time we go into, we have a yield curve inverted as much as this is, we get a recession. So we'll see if the markets have it right, if the Fed has it right. and I'm not sure Jay Powell's going to have a good answer for you today.
Or if it's the dreaded 4 words in the finance industry, this time is different. Michael McKee, thank you so much. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
There's certainly a bit of a bearish tone this morning, Lisa, with the S&P 500 headed to its 4th down day in a row, the longest losing streak since May 4th. If it sticks on the open and the close, starting off with what is really dragging Tesla down about 3%. The stock now down closer to 10% in 2 days. Some of the froth from the recent trading coming out. And in fact, today, Morgan Stanley cutting to an equal weight from an overweight analyst Adam Jonas, citing valuation, saying that the NVIDIA and AI froth has been hitting a lot of big tech. Boeing also down about 2.8% as its biggest part supplier. Spirit Aerosystems suspends production after union workers voted to strike. And then finally, Accenture, the tech consulting firm, falls on slightly light revenue growth. Bookings to be about the same in the current quarter from the last quarter, Lisa. It doesn't seem like anything outrageous there, but investors certainly not reacting to it well. That stock down about 5%.
Abigail, thank you. Coming up, all eyes on India as Prime Minister Modi meets with President Biden.
We're moving into a new era on foreign policy that is reminiscent to the old era during the Cold War, which is your allies aren't necessarily your perfect friends. India is a new big player on the world scene, vis-a-vis China, vis-a-vis Russia.
That conversation still ahead. A softer tone ahead of the open, about 18 minutes to go. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
India is a new big player on the world scene, vis-a-vis China, vis-a-vis Russia. So we're seeing now this new era of foreign policy, different sets of alliances and calculations.
Indian Prime Minister Narendra Modi holding a bilateral meeting with President Biden today. The pair expected to announce a series of deals aimed at improving economic ties, and Modi's timing is convenient. India's economy is buzzing and boasts a rapidly growing consumer market. Bloomberg's Enda Curran joining us now with more. Enda, how much is the focus really shifting from China to India as the main engine of growth and the partner that you want to be close to?
Well, there's some zeitgeist going on here, no doubt. Lisa, there's inflows into India's stock market, inflows into the bond market. people are talking about India now as a kind of an alternative, perhaps manufacturing center, because sentiment towards China took such a knock over the past few years, both with the end game of COVID-0 and, of course, the geopolitical tensions. Obviously, business people are looking around. But, you know, it's not necessarily a linear story. The FDI data into India this year is actually cooled, by the way. It fell over the first quarter. And at the same time, you aren't necessarily seeing dramatic shifts of outflows from or changes in the FDI story in China either. So, yes, it's emerging as this potential alternative. People are talking about India in a way they haven't for a while. But I would just say that the China story hasn't completely gone away yet either.
How much, though, is this really highlighting the closeness of India to the U.S., even if they haven't been particularly vocal with respect to the Russia-Ukraine war or with what's going on with China and the increasing antagonism between the U.S. and China?
Well, the U.S. has clearly been pushing for this relationship to get on more solid ground over the past few years. We've had the new Indo-Pacific term getting rolled out. We, of course, have had the Quad getting rolled out, bringing together Australia, Japan, India, and the U.S. Now you have this meeting, the state visit, lots of expectations around some commercial deals, some military cooperation expected as well. But at the same time, Lisa, India does take its own path in foreign policy. Like you mentioned, it hasn't gone down the road that many Western nations have when it comes to the stance taken on Russia's invasion of Ukraine, for example. There still are significant differences on that front. So India follows its own path, but there's no doubt that the U.S. is trying to leverage it as an ally in that important part of the world, and of course as a counterweight to China's influence in the region too.
Andy Curran, thank you so much. As we do await for a joint press conference later in the day, Alessio DeLongis and Megan Robson still with us. And Alessio, I'd love to get your sense and how much you're watching some of the the geographic changes in alliances as you shift into figuring out how to veer into the developing world and the assets that you like best.
Well, you know, India raises it's a very interesting topic because it's one of those countries or regions, really, given its size, that plays, as of today, a much larger role geopolitically than it does in global financial markets as of yet. It's an both economically and financially, it's an economy that, compared to China, compared to definitely the rest of Asia, has much more of a closed economy with less reverberation, less impact on the global economy, despite the size of its GDP. Its exports and imports as percent of GDP, one of the lowest in the emerging world, and similarly, on the capital account side, they're very close. So it's an economy that offers great potential for migration upward in its integration in global capital markets. And I think the emerging markets universe actually needs more of that presence, more diversification away from the pure manufacturing play that Asia has represented for a long time.
There are two ways to play this. There's the one hand with Alessio talking about potential investment opportunities and where the growth's going to come from. And then the flip side is, where are the investors going to come from for U.S. debt? And Megan, I'm wondering, when you look at the granularity of that, and where money is coming from to buy some of the securities once dominated by Japan, once dominated by China, Chinese investors, once dominated even by European investors, where is it coming from today?
Lisa, so we have a variety of investors still buying credit. I think for investment grade, you have a really strong LDI demand, primarily domestically in the U.S. For IG, you also see Japan, to your point, being very important. So we're watching Bank of Japan policy in July and what they proceed to do with yield curve control as an important driver. In our base case, we do think the BOJ will increase the target of YCC to 100 basis points. And so you might start to see some of that demand from Japan start to decline a bit. But overall, our preference in IG is for the long end based on that stability that you see from yield buyers still.
So from the investment standpoint, Alessio, where are you seeing the greatest opportunity when you look outside of the U.S.? And are those opportunities looking better than even what you're seeing in the United States?
We're seeing really, really great opportunities to begin to harvest attractive yields in the fixed income space in the Eurozone and in the UK. We are seeing, it's true that the yield curves are meaningfully inverted and are likely to remain so for a prolonged period of time, but moving duration towards the intermediate part of the curve, where we're seeing nominal yields in the IG space at 4 or 5% levels with an inflation picture that is expected to decelerate very quickly towards that 2% target by 2024. These yields offer very attractive real yields. We've mentioned earlier, just look at the 2-year part of the curve in the UK, in the Eurozone, or even in the United States. We're seeing real yields that we have not seen in a generation of this investment community. So as we're seeing the higher likelihood of a larger recession into 24 and into 2025, right now, in the face of this tightening cycle, I think beginning to harvest those real yields in the intermediate maturities is a great opportunity to start diversifying away from equity markets.
Just as we reset with about 8 minutes to go here until the U.S. Open, Alessio, from your vantage point, how have you reset your mid-year expectations, your views in terms of where you see opportunity heading into year-end?
I think heading into year-end, we are at a bit of a pivot point. We are currently positioned defensively. We still think, as we just said earlier, maintaining a quality bias in those equity market exposures is a sounder approach than throwing in the towel on equity markets. We are not in an environment in the economic data or in financial markets to really position in an overly bearish way, waiting for that recession. This bearish positioning needs to be validated quickly, and this is not the environment where the economy is going to validate that bearish positioning. So maintaining a defensive portfolio while being fully invested both in equity and fixed income, but within equity and fixed income to tilt towards the defensive sectors and styles. As we said, maintaining that longer duration posture, especially through the exposure to quality and low volatility stocks. However, there will be a point in my mind in the summer or in the fall where if the inflation picture falls very quickly while the unemployment rate, it remains at all-time lows, the market will give another shot at a risk rally more in the cyclical sectors, very similar to what we saw at the beginning of this year. Between December 2022 and February 2023, we had a very powerful quarter of risk-on pro-cyclical rally, which was not the beginning of a new cycle, but rather a pause while we wait for that recession.
Alessio DeLongis, Megan Robson, both of you, thank you so much for spending time with us this morning. Coming up, the morning calls, and later, Mark Heffley of UBS joining us around the opening bell. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Time now now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Bernstein upgrading Kellogg to market perform, $62 price target. The analyst optimistic on an improved earnings outlook and spin-off plans. Next up, Deutsche Bank upgrading AB InBev to buy, price target of 60 euros, seeing the company's headwinds likely to fade. And finally, Bank of America downgrading AES to neutral, price target $23. Coming up, the market open. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Just seconds away from the opening bell, hawkish central banks lower prices on equities. That has been the theme, led by the tech sector. NASDAQ shares, NASDAQ index down 0.4% as we head in to the opening bell. S&P futures lower by about 0.25%, same as Russell 2000. Yields higher on the front end as people take into account the fact the Bank of England and the Norwegian central banks both surprised to the upside with 50 basis point rate hikes. And we do get some more expected to be hawkish proclamations from Fed Chair Jay Powell at about a half an hour time as he takes the seat on Senate floor, on the Senate front of the Senate Finance Committee in day 2 of his semi-annual testimony. We've been watching this grind higher and how it's affected some of the stocks that have been bid up most and those that have lagged behind. One stock to watch at the open is Boeing. The company's biggest supplier, Spirit AeroSystems, suspending production after union workers voted to strike. The dispute comes as Boeing prepares to increase output of its 737 MAX jets. Abigail Doolittle is back with us for more. Abby, what's the latest?
Well, yeah, shares are lower, Lisa, by about 3% as investors fret about the fact that Spirit AeroSystems, its largest supplier, its production, as you mentioned, is halted over the fact that Their workers are striking. They're hoping to reduce the growth. If you look at the financials on this company, because of some of the tragedies in 2018 and 2019, I believe, there are big declines. Revenue, on the other hand, has been growing. This year, it's modeled to be at 15.5%. But if they can't get the parts to make that cash cow plane, then there could be a real problem. So I think that that's what investors are really fretting over here. The stock on the year up a little bit less than 10%, so underperforming the S&P 500 at this point. But it's really going to be a matter of how long this strike goes, a complete unknown. The longer it goes, the more it's likely to weigh on this company and the prospects of being able to get that revenue growth that analysts are modeling right now, Lisa.
Thank you so much, Abigail. We're also watching something similar over at UPS. Turning to tech, NVIDIA is now one of the most popular stocks among investors looking for an ESG play, particularly if they're looking for AI exposure. Investors say they're turning to the chip maker for its risk management processes and the steps it takes to be environmentally friendly. Katie Greifeld, NVIDIA, an ESG stock. Explain.
NVIDIA is ESG. You heard it here first. Bloomberg crunched the numbers, and based on filings, there's now over 1,400 ESG funds that directly hold this chip maker and a further 500 that are indirectly exposed. Now, according to Bloomberg data, that makes NVIDIA more popular than traditional ESG names such as Vestas Wind Systems and, of course, Tesla. Now, that's obviously been great news for those ESG funds since NVIDIA. It's up nearly 200% this year. And I want to point out that this chip maker, it holds their annual investor day today. So we'll see if the executives can deliver on that hype and keep it going. And it's also worth noting that competitor C3 AI also holds their annual investor day today. And if you look at the performance so far, you can see that C3 AI, it's higher by about 250% so far in 2023, but still far away from its all-time high. So we'll see how today goes, Lisa.
I'm glad you mentioned the investor meetings. We'll be watching those closely. Katie, thank you. Sticking with tech, Morgan Stanley downgrading Tesla to equal weight, price target $250. The analyst rating, quote, "We see Tesla as an AI beneficiary and an auto company. High expectations on the former has brought the stock to a fair value." Meanwhile, Amazon in the spotlight. The e-commerce giant is being sued by the FTC. The agency says Amazon allegedly duped customers into signing up for its Prime membership service and then made it difficult to cancel. Isabel Lee has more. Isabel, a lot of people have had trouble trying to cancel their membership. What's the latest?
Hi, Lisa. So that's exactly the crux of this whole lawsuit. So it's so hard to cancel an Amazon Prime membership, which, by the way, costs $139 per year, that FTC said that a subscriber has to go through 5 pages when using desktop and around 6 if using mobile. In fact, internally, it found out that Amazon called this process the Iliad in reference to the epic poem that detailed the final year of the 10-year Trojan War. So around 167 million shoppers have Amazon Prime. That number has been kind of unchanged since the last year. And FTC said that Amazon is duping its customers, that it's not good. And this isn't the first time. They're not really singling out Amazon because FTC did start looking into this in March. So it may crack down on other companies. Year to date, though, Amazon is up around 50%, far outpacing S&P and the NASDAQ, Lisa.
Isabel, thank you so much. Turning now to banking, Deutsche Bank CEO Christian Sewing telling Bloomberg in an exclusive interview that while he sees a possible recession later this year, the bank itself is seeing growing momentum, expecting trading results in the second half of the year to improve. Sewing saying, quote, "I think economies have really shown how resilient they are. We could already see also now in June on the most recent days that there is the momentum in the business." Bloomberg's Guy Johnson joining us now with more. Guy, I got to say, really interesting to see an increase in expectations for trading after so many people wrote off so many sections of banking just in general due to perhaps an upcoming recession, maybe not.
Well, I think there was an expectation that the macro environment, Lisa, was going to be stabilizing, and that, in theory, should be bad news, particularly if you're a fixed income trader. Sewing basically interested implying that he doesn't think that's going to happen. It's interesting. He talks about the fact that he thinks that actually there's going to be momentum in the second half of the year. His CFO, James von Moltke, warning a few days back at a conference that actually we could see a 15 to 20% decline in FIG for Q2. He's now saying that likely is a blip, and we're going to continue to see the volatility going forward, and as a result of which we think it is going to pick back up again. You've only got to look at today, Lisa. Look at what is happening. 50 basis points in the Norges Bank, a surprise 50 from the Bank of England, 25 from the Swiss National Bank. The macro volatility continues, and we're going to hear day 2 of Powell a little bit later on.
Guy, thank you so much. Mark Heffley of UBS preferring fixed income to equities, writing, quote, investors face a balancing act. There is a path higher for stocks, but it is a narrow one. After a strong run, the upside to stocks is now limited, and increasingly bullish equity market sentiment speaks against chasing the S&P 500 higher. Mark Heffley, I am so pleased to say, is joining us now. Mark, even though there has been this feeling of a no landing suddenly resurgent among a lot of analysts, why do you push back?
Well, I think you're seeing it today with the Bank of England, right? Surprise, inflation continues in Western economies, and the central banks feel compelled to attack that aggressively. And of course, you know, the FTSE is off today along with other indices. So I think one pushback is that the inflation picture is far from certain. And then the second picture, particularly for U.S. equities, is these valuations are stretched.
Right now, we're looking at the potential for interest rates to come down pretty dramatically, or at least at the long end, if growth does slow materially. Are you doubling down on that essentially with your fixed income call, that we are going back to a regime in which interest rates and rates remain low?
Well, the funny thing is that you don't have to double down on that, right? Because the market's already pricing that interest rates are going to fall off, but that earnings for companies are going to be strong. I think consensus is for flat earnings, not a fall in earnings. And so therein lies the difficulty with stocks going higher. But I think that, you know, when you look out longer term, there certainly are forces that we believe will take some of the inflation out of the picture and create a more benign environment. The question is, how much does the economy have to slow to get there?
One thing that I've noticed is in the themes as people reset for the mid-year review is that AI seems to save everything. And basically, this is the haven if you believe that inflation's going to run amok. It is the haven if recession comes along and kills this consumer discretionary. It is the haven if you don't know what else to do. Do you buy into this, Mark?
You know, haven, to quote Paul Simon, every generation throws a hero up the pop charts. I mean, I think, look, it's been an amazing run, and there's no question over the longer term, AI is going to mean something. But things have gotten very, very stretched here. And over the near term, you know, you try ChatGPT once and you say, wow, this is amazing. You try it twice and you start saying, hey, sorry, these answers don't make any sense. And I think the market might take a second look and get some of that feeling as well.
So how do you recommend for your clients around the world who are trying to get in on some level? Do you say just pump the brakes for a second? You might want to sit this one out.
Well, I think that the most important thing for people is to play the whole chessboard now, because with such a concentration and a run-up in U.S. equities, we're looking at things like emerging market equities, which trade at a 36% discount to U.S. equities. We're looking at things like emerging market bonds, which have very attractive yields. And we're looking at a weaker dollar and what that could do for both, say, oil and gold. So this is a time probably for a lot of clients to diversify.
When you talk about diversification and going overseas, how much are you sort of encouraged by the moves that you saw from the Bank of England, the Norwegian Central Bank, as well as even Turkey today, that there seems to be a real discipline and a desire to get inflation under control with significant rate hikes?
You know, I think that getting inflation under control and not letting those expectations become unanchored is critical. And, you know, they have not yet become unanchored in the United States. And I'm sure Powell will add a little extra vim and vigor to his testimony today, given what his colleagues across the globe have done.
What would you have to hear, or what could cause concern enough for you to move away from your fixed income call in terms of not necessarily doubling down on the inflation fight enough in the U.S.?
Well, I think that what has surprised us a lot has been the continued strength of the U.S. consumer. And, you know, as long as that consumer is able to spend, especially for the U.S. economy, that's going to keep the economy booming and earnings strong. So that's one of the things that we're watching very closely.
And how much does that sort of discussion around student loans coming, the payments coming back online in October, this idea that some of the
willing to run up debt, credit card debt, other kinds of debt, And so we're looking for it more in the spending and the borrowing. And, we've seen personal bankruptcies go up a little bit here. So, I wouldn't focus on one metric in the debt. I'd probably look a little more broadly at the metrics coming through.
We're speaking with Mark Heffley of UBS, who has a rich history in trying to understand how best to allocate in difficult times. And Mark, one question that keeps coming up is 60-40 debt. A lot of people say it's actually the most alive it's ever been if you look at returns on both just absolutely supporting one another. How are you advising going into the second half? Are you basically saying it should be 80-20, or are you saying it's got to be more 50-50 with just a more discerning look at the 50 in equities?
Well, we're away from 60-40 because we think alternative assets, which have grown so much as a proportion of the market, need to be part of that equation. Now, what the what the exact numbers are really depends on what stage you're at your life and how much risk you can sleep with. But I think that the 2 points to take away are, one, alternative assets, hedge funds, private equity, private credit, they seem to be low in a lot of our clients' portfolios. And then secondly, I think all of us are getting reacquainted with yield now that we've moved convincingly away from the zero bound on inflation and interest rates.
One thing that's funny is that as you talk about private credit, your colleague at UBS, Matthew Mish, put out a note last night talking about private credit default rates expected to peak at around 9.5%, saying that there are opportunities, but there also are these potential pitfalls. How do you navigate at a time when people are still expecting pain in the economy and these interest payments are expected to rise substantially? How do you identify the companies that can withstand that, the non-zombies, amid the zombie universe?
Well, I think this is a great question because, if you think about it as a client, from a client's perspective, that has underallocated to that sector, and many clients don't even know what private credit is. They're looking to deploy capital now into new funds, and what you see is that it's the funds, the vintages of funds that are started after equity markets have had a 25% sell-off like they had last year. Those are the funds that tend to perform the best. So, the headlines are about the companies that are currently in portfolios that are perhaps doing badly. But for investors today, it's how do I reap the benefits from that as capital is constrained in the sector?
Mark, before I let you go, what do you think is the biggest mistake that so many investors are making right now? What do you think is the biggest wrong assumption that is prevalent in markets?
Well, everybody buys what was working last month. And so, we've seen this tremendous run up. You were talking about the holdings in NVIDIA, and, that's great. But it's really about what's next month, what is going to happen with the economy, what is going to happen with earnings, and then look at these stretched valuations.
So in other words, you think that people are perhaps overweighting stocks a bit too much. Is that correct?
Yes, overweight stocks. Try to get some yield in your portfolio at this time. It's a much better risk-reward trade given the potential for volatility to rise.
Mark Heffley, thank you so much for taking the time. And you are talking on a day 4 of declines right now in U.S. equities as banks around the world, central banks, do put out hawkish proclamations. You've got the Bank of England with a 50 basis point rate hike, as well as the Norwegian Central Bank. We're seeing the NASDAQ actually turn positive, so you can't keep a good tech stock down. S&P 500 down 0.2%. The Russell 2000 still lower by the most, taking a deep leg lower about 1%. And you are seeing in the bond space yields higher, price lower as people game out higher for longer. You're watching The Open. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The race to dominate the electric vehicle market continues heating up, especially when it comes to competition with China. We got word this morning of a $9.2 billion loan that the U.S. government was extending to Ford to create 3 factories of electric vehicle making as the U.S. tries to gain a competitive edge against China, which has dominated the industry for so many years. This really speaks to a groundswell of fiscal support for all things tech in the U.S. Joining us now at the Auto Angle is Keith Naughton. Keith, I'd love to get your sense, first of all, of how unique this $9.2 billion loan actually is and what we know about the details of its terms.
Yeah, it's one of the largest government loans given to the auto industry since, the bailouts of General Motors and Chrysler more than a decade ago. So it's a big loan. General Motors received a similar loan late last year, but it was $2.5 billion. So this is much larger than that. It goes to both Ford and its battery partner, SK On of South Korea. They're building 3 battery plants, 2 in Kentucky, 1 in Tennessee, that'll utilize this money.
We've heard about a lot of people saying this is going to revolutionize the EV manufacturing industry. Is that true, Keith? Do you actually believe that there is the will to build this, to staff it, and then for it to become a competitive behemoth versus what China offers?
Yeah, so Ford is pouring $50 billion into developing and building electric vehicles, and they plan to be building it at a 2 million annual rate by the end of 2026. This is a key part of that because batteries are the most important aspect to scaling up production of electric vehicles. Ford CEO Jim Farley has said in our story. So this is key to trying to catch up to China, which is the world leader in electric vehicles and batteries and battery materials.
Do we know what the terms were of this loan, Keith, what the strings attached really consist of?
Well, as the Department of Energy explained it to us, it is certainly better terms than Ford would get if it were to go to Wall Street and just borrow this money. So, it is a good termed government loan. They didn't give us precise details.
Well, how much is this really Ford getting, I don't want to say bailout, but getting assistance from the U.S. government to build these plants because it doesn't have an investment grade rating versus General Motors, which does, and can probably access the capital markets at a much lower rate?
Yeah, so, the Department of Energy and the Biden administration views this as critical to U.S. industrial policy to try and catch up to China on electric vehicles. So that's why they have a pot of $400 billion that they are doling out to automakers to try and catch up in the battery race. But China still controls so much of the battery supply. 80% of the lithium-ion batteries come out of China. So, and all of the minerals and the mineral processing is coming out of China. So there is a long way to go before the U.S. catches up.
Do we have a sense of what could be next in terms of the deployment of the money that's already been promised?
Yeah, so Ford and SK are building these battery plants right now in Kentucky and Tennessee. They'll be operational by the middle of the decade. But there's more to come, too. Ford has a separate battery plant that's not part of this loan that it's doing in Marshall, Michigan, that uses technology from China's CATL. So there's this huge rush of building of battery plants and EV plants. There's almost $200 billion worth of investment going into that right now throughout the auto industry in the United States.
Keith, you've been covering this industry for decades. Do you hear from the people who are inside the building, in the C-suites, that they think that this is truly a game changer in terms of the financing from the U.S. government?
Yeah, I mean, this electric vehicle industry in the United States can't take off without some government support, because that's what's going on in China, that's what's going on in Europe. And it is the future of mobility. Carbon-free future. That's how mobility is going to go. So you need some support to get the EV market off the ground in the United States. It's still less than 1 in 10 sales in the United States. So there's a long way to go before electric vehicles dominate this market.
Keith Naughton, wonderful reporting. Thank you so much. I really appreciate it. Let's take a quick look at sector price action this morning. Abigail Doolittle. Abby.
Hey, Lisa. Well, the decline for the S&P 500 may be small, about 0.1% down, but we have a number of sectors that are down more. Real estate and energy both down more than 1%. Materials down close to that amount. Up top, we have some defense, consumer staples, and healthcare. As for the chip sector and AI, it is down for a 5th day in a row, the longest and worst losing streak since the end of April, down about 5% over that time. So the big question remains, is air coming out of this AI chip bubble?
Abby, thank you so much. Coming up, the market moving events you need to be watching. That's next in our Trading Diary.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Time now for the trading diary. You need to be watching through next week. Fed Chair Jay Powell testifying in the Senate at the top of the hour. Plus, we'll get U.S. existing home sales rounding out the week with Fed speak from Jim Bullard. On Tuesday, we'll get U.S. new home sales data as well as a read on the consumer confidence from the Conference Board. And next Wednesday, the Fed releasing the results of its bank stress tests. Plus, we'll get Micron earnings. And later today, we do get the NVIDIA meeting of shareholders, which should be interesting. Right now, we are seeing in markets, NASDAQ getting forward, 0.3% gain. This was Countdown to the Open. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Fed Chairman Jay Powell, he is testifying. He will be testifying in front of the Senate today. We will not bring that live, but we'll bring you some good analysis of what he said yesterday to the House and what he's likely to say today. So that's coming up. We got some eco data out today. Jobless claims kind of in line with last month. Leading economic indicator, a little bit worse than last month. So we'll break down some of that eco data with some smart analysis. But first, let's kick this whole thing off with Nathan Hager and a Bloomberg Business Flash.
Yeah, I got some economic data just crossing the Bloomberg terminal. Paul, sales of previously owned U.S. homes barely rose in May as high mortgage rates continue to crimp demand and discourage owners from listing their properties. Contract closings edged up just 0.2% to an annualized pace of 4.3 million. And the May index of leading economic indicators fell 0.7% in May. It is adding to a dampened mood on Wall Street. Stocks are drifting as policy tightening fears from the U.S. to Norway and the U.K. hobble a bull market return. How about the Bank of England unexpectedly raising its benchmark interest rate by 0.5 percentage point? BOE Governor Andrew Bailey's warning they may have to hike again to fight the worst bout of inflation the UK's seen since the Thatcher days.
We've got very low unemployment, but it is leaving us with inflation looking much more persistent. We think inflation's going to come down markedly this year, but there are signs of it being more persistent. And I thought it was right that we took this action and this decisive action today.
And while we wait for Chairman Powell's second day of testimony on Capitol Hill today, another Fed speaker, Federal Reserve Governor Michelle Bowman, is saying the central bank needs to raise interest rates further to bring down U.S. inflation, adding her voice to policymakers who want to keep hiking after taking a break last week. We check the markets all day long for you here on Bloomberg. And right now, the S&P 500 is down 2 points. That's little change to the downside. 43.62 is the S&P level. The Dow Jones Industrial Average is down 46 points, a drop of 0.1%, 33,906. And the NASDAQ holding on to a slight gain, up 15 points or 0.1%. 13,519 is the NASDAQ level. The 10-year Treasury is down 11/30 seconds. The yield 3.76%. The 2-year yield is at 4.74. NYMEX crude's plunging down 3 1/3%, down $2.42, $70.10 for a barrel of West Texas Intermediate. COMEX gold is down 0.7%, down $14.10 at $19.30.70 an ounce. The euro trades at 1.0981 against the dollar. British pound is weaker against the dollar as well at 1.2753. The yen is at 142.46. Bitcoin's higher by 0.8%, just above 30,000 at 30,227. That's a Bloomberg Business Flash. Bloomberg Markets is on this morning. Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much. We appreciate that. Jess Menton and Paul Sweeney here in our Bloomberg Interactive Broker Studio. So apparently, Jess, we are going to take some of Fed Chairman Jay Powell's Senate testimony today. Only the juicy parts, maybe a couple of questions.
I sense maybe we'll get some more Grateful Dead references, more so than policy.
Well, I understand that the Dead and Co. were in New York last night. I think they're playing out at Citi Field, and I think Matt Miller may have been there, along with several other
I'm
Bloomberg
excited.
television people. So, maybe we can get Matt in here.
Joe Weisenthal, I saw on Twitter.
Oh, is that right?
Was also, I believe, was there.
All right, so Bloomberg TV, Bloomberg Media had a nice little presence there at the Dead and Co. last night.
Can't wait to get an update.
Yeah, maybe we can get some reporting on that. Looking at the market here, pretty much unched on the S&P 500, but let's bring in Abigail Doolittle. She covers all the market stuff here for Bloomberg. She joins us here in our Bloomberg Interactive Broker Studio. Abigail, what are you looking at this morning?
Today's going to be pretty critical, I think, relative to the S&P 500 and whether or not this little meltdown that we've seen, if the S&P 500 holds on to this little bit of a loss, or if that were to grow, that would be a fourth down day in a row, the longest losing streak potentially since early May. And from a technical perspective, the S&P 500 is fighting to hang on to its 10-day moving average. And so I would say if investors bounce it off of that, or if there could be a little bit more of a decline below these levels and then higher, I think that the melt up could continue. But let's bring back in the RSI, that momentum indicator. It is firmly rounding back down from overbought territory, and it's been a long time since we've seen it going down and then back higher again. So from that historic standpoint, recent historic standpoint, I would say that this may suggest that this 10-day moving average isn't going to hold. The question then is why? Is Jay Powell going to say anything new today? Probably not. I mean, he reiterated the message that investors for some reason don't want to hear, that they are in hiking mode. It's amazing, actually. Our charts team put together a chart of the number of cuts that investors are expecting next year. It's nuts. I think it's like it's somewhere between 1 and 3. I could pull it up on Warp right now. But the point is, the markets are expecting big cuts next week. Jay Powell last week, or excuse me, next year, Jay Powell last week said they're not cutting anytime soon, maybe not for years.
Right.
So there's this huge disconnect still between the markets and investors. And I would continue to put money, if I were betting money on the Fed as opposed to investors.
And something that's come up a lot in my conversations is that typically cuts aren't something that usually bodes well for the broader equity market. If you think back to, say, like the early 2000s with those emergency cuts that the Fed obviously did at the beginning of 2001. From a technical perspective, I know 43.25, the August 16th intraday high, before we obviously breached that earlier this month, that was clearly a level of resistance. Now I'm wondering, Abby, if this is more of a support level. Right now with S&P trading around 43.64, so still well above that, but kind of wondering what you're looking at when it comes to those support levels for the index.
Well, that's a great point that you make on the rate cuts, that it might not necessarily be a good thing in the middle of what has been a hiking, that if it were to come, it would be because there's some reason that they need to create that kind of stimulus. In terms of support, it's been a long time. I know it's funny, like I look at charts like that, but it's been a long time since I've actually really kind of done a little bit of work. I would say it's a little bit lower than the levels that you're talking about. I think that we're going to see the S&P 500, as I look at this chart, probably come to the 42.82 level. If below that, so that's actually below, interestingly enough, that's the 10-day 10-day moving average. So this is a weekly chart I'm looking at. That's not the 10-day moving average. I don't think support in here is going to hold. I think at a minimum we're going back down to about let's call it 4,300, but I think that we could go lower. I think that the melt up is turning into a meltdown, and so one point that I'd like to make here is trend shifts are very subtle. They take some time, but they start off this way. They often don't. It's not like the 5-day or 10-day or 15-day crash that results in an 8 to 10% reduction. That usually is healthy consolidation that then creates a springboard to go back higher in the direction of whatever the trend had been. When it's gradual like this, it can create some problems. So the big question for me, and because I'm not a technical analyst, I can ask this question, because a true technical analyst will never ask about the why. They're just simply looking at price, assuming everything's priced in. But the big question is why. So I think that what stands out to me looking ahead is, of course, yes, the Fed in July, but it's also earnings. I think I had mentioned last week or the week before that this time last year, everybody was so bearish on the second quarter earnings season. I think everybody now is just sort of complacent about it. These companies, they've got it. Like, this recession everybody's waiting for is not going to happen. I don't know. I think that maybe just because this chart is suggesting that there's going to be some more consolidation and that it's not going to be overnight type of consolidation, that something is ahead. So I would look to earnings.
Yeah, July 14th is when JP Morgan kicks things off.
Oh, is that right? Okay.
Yeah, so we have about 3 weeks.
All right, good stuff. Earnings season seems like it's always just around
the
corner.
Always going on.
All the time.
Exactly.
Same thing with the Fed meeting, CPI.
Abigail, thanks so much for joining us. Abigail Doolittle, she's a Bloomberg Markets correspondent, joining us live here in our Bloomberg Interactive Broker studio. We had Fed Chairman Jay Powell. He spoke yesterday, testified in front of the House panel. And today it's his turn in front of a Senate panel today. And we're going to bring you some of those comments coming up, maybe a couple questions if we do as well. Let's get a little bit of a preview of kind of what we might get today, what we received yesterday from the Fed chairman, any change in tone or policy. Steve Matthews does this stuff. He's U.S. economy reporter with Bloomberg News. He joins us here. Steve, thanks so much for taking the time here. What do you make of what we heard from Fed Chairman Jay Powell yesterday relative to what he and other Fed speakers have been saying recently?
Well, what we heard basically was that Powell believes we're going to need to see additional interest rate hikes. I mean, this is a similar message from last week. They paused in terms of the rate hikes last week, and the message is we're not done. And, you know, he was asked, the Q&A was kind of interesting. He was asked about the dot plot, which, you know, the projections of the FOMC for rates, and they are projecting 2 additional rate hikes this year. And Powell said, that's a pretty good guess of where we see things going. So it was kind of confirming the idea that we're going to see 2 more hikes, you know, if things go as expected. the second day of these testimonies can be interesting. Sometimes if there's a big market reaction on the first day, or if something is misinterpreted, there will be a particular effort to correct the misinterpretation. I don't think anything jumped out yesterday that was like, that was a gaffe where he would need to correct. But sometimes you see that. The Senate testimony can also be somewhat more interesting. The House was asking a lot of arcane questions about bank regulation, and bank regulation will be discussed again today because it's a hot topic after the banking failures of March. But sometimes the senators can be more thoughtful and interesting in their questions. And you have like some stars, like, people who everybody know, like Elizabeth Warren is on this panel. And whenever she can, if she wants to, kind of light a fire under Powell and make him feel uncomfortable. And it's not clear that that's what is going to be her goal today, but it's always an interesting exchange.
Yeah, it definitely is. So it seems like it's probably going to be more banking regulation that we're going to get on that front rather than, to your point, when it comes to the policy. Something I was curious about is between now and the next meeting in late July, we have another CPI report on July 12th, but is 1 month of data enough for them to sway them to raise rates one more time or potentially pause there?
Well, it's interesting, and no one asked Powell specifically about the next month's meeting. Markets are pricing in the likelihood of a hike. The way things went last week kind of suggested that their base case is that we'd get a hike in July. But we haven't heard that specifically, and there are different views. We had Mickey Bowman, the governor, who's a banking background, spoke today, and she was saying we need more hikes, and was fairly assertive about it. Raphael Bostic spoke late yesterday, the Atlanta Fed president, and he was saying basically hold off all the rest of the year. I mean, the CPI is going to be really important. Particularly the core CPI, excluding food and energy, because we've seen a big decline in the overall CPI, but not really so much on core prices. If we get a big decline in core prices, that could push things off.
So it's interesting here. I mean, Steve, I seem to remember a little nugget back in my days at Duke Business School, this whole concept in economics, long and variable lag. I mean, we've raised rates over 500 basis points. Why can't we just sit on the sidelines for 4 or 5 months and see what happens?
Well, that is exactly what the Atlanta Fed President Bostic is saying, is that, these lags can last 24 months or 18 to 24 months. And if you're going to get the impact over the next year of what's already happened, maybe you should wait and see. The flip side of that is, as Neil Dutta of Renaissance says, long and variable lags have become short and predictable lags, because it's like markets now are pricing in the Fed rate path, and the markets were pricing in the Fed rate path before the Fed even started raising rates. So, in terms of financial conditions, they react fairly close to immediately to what the Fed is doing. So the lags seem to be shorter today. There's a big debate on that, and that is really the central question. You're identifying it for what happens with policy. How long are the lags really?
When it comes to these central bankers, obviously we have a batch of other speakers. You were talking about Michelle Bowman earlier, Loretta Mester speaking today, as well as Tom Barkin later. Mester and Barkin, as you know, not voting members, but I know we'll hear from Jim Bullard later this week, who's still in Europe. He's speaking at a conference in Ireland. Obviously not a voting member this year, but obviously an influential voice. When it comes to these members, who stands out to you the most as far as who you think investors are really taking critically whenever they give their statements?
If particularly for investors, I think Bullard and Chris Waller, the governor, both stand out. And what's interesting about them both is, Bullard used to be Waller's boss, is they're both kind of technocrats. I mean, they're both have been very hawkish over the last year, but at various other times they've been extremely dovish. And they seem to be reacting very much to the data. And, you know, they're not ideologues. They're not like always going to be viewed as hawks or always as doves. And you know, they're pretty good signals.
Jess, you know, I always forget when we talk to Steve that he got his MBA at that trade school in Chapel Hill.
Oh, really?
Yes.
I didn't realize
yes,
this.
that's a whole different background. Steve, you're down in our Atlanta bureau. You've been down there for a while. Give us a sense of how the Atlanta economy is. Is it still just a boom town? Is that whole Sunbelt thing still a thing down there?
It is still booming. I mean, there was a slight tick up in the unemployment rate as there was nationally in Atlanta and Georgia. But generally speaking, the Atlanta area is creating a huge number of jobs. You walk outside and there are construction cranes and they're still building, you know, offices and residential buildings. I guess some of these have been in the works for a few years because it's like you hear about how, you know, there's not necessarily, you know, new projects underway, but there's certainly big projects. There are battery plants and EV car factories that are being planned in Georgia. I mean, this area is kind of booming yet still.
Something that I know, it's still a little bit a ways, but the Employment Cost Index, which is quarterly, comes out on July 28th, but that's actually right after the Fed's next meeting on July 25th and 26th. But I know this is something that Fed Chair Jerome Powell watches very closely when you're thinking about, obviously, wages and how that correlates to inflation. How critical do you think that data is? Obviously, more backward-looking, Steve.
Yeah, I mean, I think Powell is very interested in it, and it's like, you know, half or more of the FOMC is very interested in it. There's several ways to kind of look at wage data. The Atlanta Fed has a wage tracker, which remains fairly elevated. You know, you get in the employment report, you get average hourly earnings, and all of those still show, you know, fairly big wage gains. But, you know, there's been some pushback against that, too. I mean, Powell, you know, he has cited that when they did one of the jumbo rate increases last week, he cited ECI in particular. But in recent months, there's been a big pushback by people like Austin Goolsbee and even Jim Bullard basically saying wages follow inflation. Wages do not cause inflation. And you know, the relationship between what's happening with wages and future inflation is very questionable. So while, you know, some of the traditional folks at the Fed, including Powell, definitely look at it closely, you know, there's a big debate over what it really means.
Hey, Steve, I just wonder I wonder how the Fed thinks about, you know, the labor market here. We got another initial jobless claims today, came in at 264,000, up just a smidge from, or actually even with the revised number from last week. Can you really have a recession with, you know, a pretty strong, still actually quite strong labor market? How do you think the Fed thinks about that?
Yeah, you are right. You cannot have a recession with a strong labor market, and the National Bureau of Economic Research, which calls recessions, basically includes what's happening with payrolls as one of the indicators. But what Powell said yesterday was, we are overachieving on the maximum employment mandate, meaning we're overshooting maximum employment.
Yep.
So their view is there's still, you know, the labor market is still too high and unsustainably tight, and it needs to cool off some.
All right, Steve, thanks so much for joining us. Steve Matthews, U.S. economy reporter with Bloomberg News down in our Atlanta bureau. Now we're going to go to Washington to bring you some questioning from Fed Chair Jay Powell. Senate testimony this morning. Let's head down to D.C. right now.
2 times before the end of this year. We've come very far, and the reason why we maintained our rate at the last meeting was to give ourselves more time to stretch out the time for making these decisions. We moved very quickly at the beginning, and we've gradually slowed down. This is just a continuation of that. But we are committed to getting inflation under control, and the strong majority of the committee feels that we're close, but there's a little further to go with rate hikes.
Well, thank you for that answer, but Mr. Chair, what Fed governors call cooling down, regular people where I live call them layoffs. I mean, the question is, why should working families continue to bear the cost of fighting inflation? Why should they lose their jobs so that corporate profits can continue to balloon? Let me move to the next question. Our economy's created 13 million new jobs in the last 2.5 years. Black and Latino workers with the lowest incomes have seen the greatest gains in job opportunity and wage growth. What the Fed considers too hot an economy has given these workers their first leg up in decades, if ever. We know that job losses will hurt those same workers the most. How will higher interest rates and the resulting job losses disproportionately impact Black and Latino and low-income workers?
Well, we have quite an unusual situation in the labor market where we've had persistently much higher demand for workers than the available supply of workers. So some of the process of getting demand and supply back into alignment has been taking place through declining job openings and through lower quits rates and through wages that are moving, that are still very high, but moving into more sustainable levels of increase. So actually there hasn't been a meaningful increase in unemployment. The unemployment rate has bounced around at historically low levels, and that's fine. That would be the perfect way for this to continue to happen. There's no guarantee that will happen. I would just say that it is working families who suffer most directly and quickly from high inflation, and it is for the benefit of those people and all other people that we need to restore 2% inflation in this country on a sustained basis.
And thank you, but in the dual mandate suggests that those workers, that obviously you look out for those jobs and those workers, but we also know that those workers are the first to be laid off. And I would hope that in your next meeting, the Fed recognizes those disparities and gives them real weight as you make decisions that will likely at some point result in more layoffs. Probably my last question. Since you last testified in front of this committee, we've had 3 of the largest bank failures in U.S. history. You explored that a bit at the end of your testimony because the executives at those banks failed at Banking 101. Regulators took swift and decisive actions to protect the banking system and depositors. Thank you for that. That's in stark contrast to regulators' supervisory failures in the years before the 2008 financial crisis. What actions are you taking today to prevent more bank failures and to make sure banks do real risk management and address liquidity and other basic risks? And you may in part want to answer, I mean, he can do it himself, but Ranking Member Scott's comments on Vice Chair Barr and where that takes us. But what do you do to make sure banks do real risk management and address liquidity and other basic risks?
So I would say we are committed, and I am personally committed to learning the right lessons from what happened in Silicon Valley Bank and the other 2 failures and vigorously implementing appropriately. I think there's a clear need to strengthen both supervision and regulation of banks of that size. And I can go into more specifics in the course of the hearing, but I do think we need to learn those lessons, and I think we've started to do that. And it's something, what we saw was an unexpected bank failure overnight led to contagion and threatened the broader banking system, and that's not supposed to happen. And we're gonna take appropriate measures to reduce the chances that something like that would happen.
Let me follow up briefly on that. The Fed plans to propose an overhauls we've talked about to existing bank capital requirements, so we have a more resilient banking sector. Is increasing capital requirements for banks with $100 billion or more in assets to prevent future bank failures? Is that a strategy the Fed plans to, is willing to deploy to promote financial stability?
So we have not come to there hasn't been a final proposal. There's been a proposal that's been circulated, but it's, in my understanding, it's not final, and I know things are still moving around a little bit, so I don't really have a final proposal that I can comment on. I do think that the capital increases that are getting so much notice are really on the larger banks. There may be also some capital increases in the proposal for banks down to $100 billion, but not below that.
And yesterday you said we want to, in particular the G-SIBs, the 8 largest banks, to have very high levels of capital and liquidity. You stand by that statement?
I did, and I said, of course, we did spend years raising capital and liquidity standards a great deal on those institutions, and I supported all of that. And then I concluded by saying that further increases, if they are proposed, will need to be justified. They'll, of course, as any change in rule would be.
Senator Scott.
Chairman, let's stay with the capital requirements as you and Chairman were talking about on the larger institutions, but frankly, throughout the entire banking system. Pre-financial crisis, capital levels were in the single digits. In the last decade, it seems capital is continually being raised. My question is, how much is too much, and when is enough enough? We are going down a path where something happens or something goes wrong, and the only default solution seems to be to raise the capital standards or the capital on the sidelines. And the formulas that I use are really simple formulas. The higher the capital standards, the lower the capital for the private sector, which means fewer loans and less capital for those who are actually creating jobs. And so when we have too much capital on the sidelines, then we have too little capital for actually creating and producing a vibrant economy. At some point, if you've raised it from single digits just a decade ago during the crisis, pre-crisis to now, frankly, rumors are as high as 20% for our GSIBs is a possible outcome. How much is too much?
I think that's exactly the right question. As you point out, there is a trade-off between making the banks safer, more secure, more resilient. You want them to be very strong, particularly the largest banks, so that they can continue to intermediate and lend money and things like that, continue to function during even stressful situations. But it's with bank capital, it's always going to be a trade-off between the availability and cost of credit and how much safety. And I think that's the question we're going to be addressing and answering as part of this process.
As you continue to work on fighting inflation, which I think is job one, another simple formula for those of us in the real world of business, we hear a lot of celebration around the jobs that are being created and the wage growth, but the way I look at it is wage increase minus inflation has led to less spending power. Do you disagree with that?
No, I think that's right.
Yeah. And so in the end, as we celebrate what seems to be a healthy economy, the truth of the matter is that the average person in our nation today struggles to make their ends meet because of the inflationary impact on their bottom line. And what that means for them is that there's a crisis for a single mother like the one that raised me, or seniors on fixed incomes. And we have yet to, as a nation, adjust for the 500 basis points increase in how we service our debt. Said differently, the more money we have to use for servicing our debt, the less money we have for meeting the needs of the American people. Therefore, printing and spending $4 trillion after COVID was over has led to the inflation that we're seeing, and that, as a result, led to the 10 rate increases. So how do you, as chairman of the Federal Reserve, talk to policymakers about the importance of being responsible from a monetary perspective? I know I've seen and heard your comments that that's not your lane, but certainly the actions that we take here impacts, frankly, significantly what you've had to do in order to slow down Biden's absolutely explosive inflation.
Let me start by saying that actually you were talking about real wages a moment ago. Yes. Real wages actually did go up at the lower end of the income spectrum, and now they are positive, quintile, but they're not as positive as we'd like to see them. Yes. So, but to your real question, I would just say this, that the U.S. federal budget is on an unsustainable path. It has been so for a long time. We need to deal with that sooner or later, and sooner is better than later. But that's what I can say, and that's what essentially all of my predecessors have said. We are not charged with supervising fiscal policy in any way. It's just, but as a high-level matter from the standpoint of the economy, that's what I can say.
Well, here's another analogy that works for me as a former football player, a running back. If my line isn't blocking and I keep getting my head hammered, I'm going to say something to the line. At some point, I think it's your responsibility to talk about the importance of fiscal responsibility. That to the side, my last thought and question for you is that SVB suffered because their bond portfolio ended up carrying water in a negative way. You have a $8 trillion balance sheet and beyond. Every report that I've read is that your bond portfolio, our bond portfolio, the Fed, is underwater as well. Can you talk to me about the losses that you're experiencing at the Fed from a bond perspective?
Remember that the way it works at the Fed is when we buy assets during QE, we pay for them with overnight interest rate reserves. And we've, for many, many years during the QE era, we've earned a spread, and we've been sending money to the Treasury way over $1 trillion since QE started. And so now that rates have gone back up to 5%, that process has reversed. And these are paper losses. They have absolutely no effect on our ability to conduct monetary policy or really on the economy. It's an accounting fact. If we retained capital, then that would be it would look completely different. But we don't. We give all of our profits to the Treasury.
So you were giving profits to the Treasury, now you're not. That has an actual effect. I mean,
Well,
if I was getting $10 and now I'm not, there's an effect.
Well, the Treasury then will have to borrow money that it doesn't get or raise taxes. It'll have to get the money to carry out the spending that Congress authorizes. Yeah. But that's not going to it's not going to affect interest rates and things like that much.
To me, I have the holistic view of our economy where if, in fact, we have fewer dollars coming in, which requires us to raise taxes, that in the end has a real